And so I would like to welcome everyone to the February 20th meeting of the California Housing Finance Agency Board of Directors. Glad you're all here. Welcome members of the audience. So with that, I'm going to call the meeting to order. There. And ask Melissa to call the roll, please.
Ms. Cabildo. Chair Cervantes.
Present.
Ms. Kurgan for Secretary Moss.
Present.
Ms. Lamone. Mr. Henning for Treasurer Ma.
Here.
Mr. Prince.
I am here.
Mr. Russell.
Present.
Mr. Fiegels for Secretary Sin. Ms. Sotelo.
Present.
Mr. Olmsted for Director Velasquez.
Here.
Dr. White. Mr. Williams.
Here.
Ms. Johnson for Mr. Acefa. Ms. Peralt for Mr. Steppenshaw. And Ms. Franklin.
Here.
Chair, we have a quorum.
That's great. Thank you very much. I've been asked to remind everyone, by the way, that these little green, when you push on the middle of this mic, there's a green light that goes on. That means that people can hear you, especially people who might be zooming in for this session. So we'll all try to take advantage of that. Otherwise, AI will take over it for us, and that'll be it. So with that, we have the minutes from our last meeting, which was January 28th. It was in the board package. I'd like to see if there's any comments on that. Otherwise, I'll entertain a motion to approve.
So moved.
Motion. Thank you, Directors Russell and Prince. Our protocol is to approve the meeting minutes with a motion in a second without going through a vote. So thank you both very much. I'd like to move on to item 3. And for my comments, I really want to sort of like acknowledge there are the people who make this all work. I mean, it's great to be on the dais here and talk about policy issues, but there are many individuals at CalHFA that really make it all function. And I'd really like to sort of thank one in particular, Melissa Flores, who's been leaving us, very sad to say, and who's been with CalHFA for 21 years, and in their current role supporting the board for the last 5 to 7, I think. Is that give or take? And I have to say that what I've learned as coming in on as board chair is that this all just doesn't happen. There are people behind the scenes that make it all work. And the logistics of making a board function are really important. If you're up to your chair, this would all be sort of a shambles at this point. Melissa's really the one that makes it all function. And I really want to sort of thank you for your work for so many years with CalHFA in really helping us get done what needs to get done to support the sort of the governor's vision for providing affordable housing in the state of California. It all functions because we're all working together on that. And like I said, there are behind the scenes people who really make it work. And thank you, Melissa, for all your effort to really make this organization function as well as it does. So I'd like to thank you with something that is now, I gather, like the CalHFA tradition, minding your time with the organization. We've got a clock, and which will be engraved at a future date. But I'd like to give that to you, and I think your husband is here as well. And if I could maybe ask him to come up with you, we'll do like a formal picture if someone can manage that, and then get going with the rest of our meeting. So I will come around the front. If you can come with your husband, that would be great.
Chairman,
Thank you.
Mr. Flores is
Yeah.
approaching.
Yes.
If it's all right, on behalf of Treasurer Ma and the things that we're trying to do as we coordinate multiple different committees, I really do think that taking this time, this moment for Ms. Flores is incredibly important. She's been a dedicated public servant for many years, her husband as well, and their commitment to the state is exactly what will propel us as the Golden State forward. And so losing her here is a tremendous loss. We feel, I think the governor was very smart in his intelligence in moving her forward, but her service in particular is worth this commitment.
Yeah, thank you so much. Great comment.
And if I might say just a couple of words to all of you, it has been an extreme pleasure to work with you. I have had the fortune fortunate experience to work with some of you from the very beginning of this role. And you've been on the board that long, and it's almost 9 years. And I am grateful that the governor has chosen you and the legislature has chosen you, because you're all so collaborative, professional, and compassionate about the work we do. And you take this all very seriously. But we also are, kind of enjoy the light times when we can. But you've made my job so much easier, and I appreciate that. Thank you so much.
Thank you.
And if I may, so first of all, now you have the chance to say who's your favorite. I wrote this to you. You have always welcomed me and all of the board members, and I know you're going to bring that same grace and professionalism to your next place. And yes, I just want to thank you for all that you did for me personally and for this organization and this body. Thanks.
Chair, may I add one more thing?
Please.
Melissa, thank you so much for everything that you've been doing, and we're so excited that you're going to stay in the state. And on behalf of Secretary Moss, I just wanted to let you know how supported she has felt by your leadership at CalHFA. And while you are going to a different part of the state family, you're still going to be connected to things that are related to housing. So we know that you're going to have thoughts in mind about how your new role can facilitate a different dimension of the work that we bring to bear here, and they're very fortunate to have you. So we know that you needed none of our referral. It's your experience, it's all kinds of things, but they're going to get to know and love you in the same way, and you'll always have a bunch of fans here. So thank you so much.
Yeah, great. Well said. All right, let's get the clock.
We told her it was like the Academy Awards, we have to take it back.
So wait, it's not known where she's going?
She's going to DIR. She's the executive director over like a small board or commission. So Department of Industrial Relations. I think it's like a specialized board
Yeah.
where it's like a staff appointment.
So Melissa, again, thank you so much. And it's really great to see that in other parts of the state, they recognize talent. They're poaching us here, but I think it's all to the good. So best going forward. Thank you. And with that, I'd like to turn this to Rebecca Franklin, our Chief Deputy Director, Acting Executive Director, to give us some updates.
Thank you, Chair Cervantes. And I just want to echo the board sentiments that while we're very sad to see Ms. Flores leave, we know that she's going to be still contributing to the state in a high quality way. So, and if you ever want to come back, we're here with open arms. So I know that the LA disasters continue to be on the top of everyone's minds. It's for us at CalHFA as well. Many of the board members have reached out and expressed sentiments of what can we do as an agency, how can we help in this recovery effort, and we've been working very closely with our partners at BCSH agency, as well as collaborating with Housing and Community Development, as they have very well deep expertise in kind of these kinds of programs in the fire response area. And so I don't know if everyone had seen, but actually yesterday the governor did release a proposal for this board to consider the use of the National Mortgage Settlement Funds, the remainder of the funds that we have, to provide mortgage relief for homeowners who were affected by those disasters in the form of counseling and direct assistance. We will have more details on exactly what that looks like in item 7. I'm very excited to be presenting that to you guys today. I think that, me personally and some of our board members who actually more in-depth knowledge on mortgage relief, but I do think I might know a couple things about it. So I'm glad to carry on those lessons learned and those learnings into another iteration. But I do want to recognize we have some board members who actually predated me in this space with the hardest hit funds. So Ms. Sotelo and Mr. Russell have sat on numerous boards now for those efforts. So excited to get your guys' feedback and engagement on that. Another update I did want to give is on our My Access program. I'm excited to say that we sent out notification to our partners on Tuesday, which included links on the details of our newest down payment and closing cost assistance program. Just to remind the board, the program will give first-time homebuyers access to up to 2.5% of purchase price and additional assistance on top of our ongoing My Home program, which is 3.5% assistance. This announcement is giving the lenders a month to prepare for what we're calling our soft launch, which will be on March 17th. So the My Access program was a effort that was kind of born out of the New Opportunities Committee of this board. So we're really excited to see one of those big ideas come to light, looking at Dr. White, who's the chair of that committee. So we're very excited about that. Also, CalHFA in the community, I just wanted to highlight that we've been out and about since we've last met. I want to call attention to some of the events that we are attending now or have attended in the past month or so. Our Director of Multifamily Programs, Stephanie McFadden, spoke at an interesting panel at the California Developers Roundtable at the beginning of the month. The topic was thinking outside of the traditional low-income housing tax credit space for the development of affordable housing. I think it's a really interesting, important conversation. I think Stephanie really enjoyed her time there. I think Stephanie has brought a breath of fresh air and a new focus for our multifamily programs that I think we're going to start today with an educational piece of our flagship program in that space, but we're not stopping there. And Stephanie and her well-equipped team is got their innovation and iteration hats on. And so I think the first step that we really are doing is engaging into that development community, understanding the needs of the market, and then we can kind of find those niche areas that CalHFA can fill those gaps for that community and support affordable housing across the state. Additionally, since we are all here today, we had a really great opportunity for our staff to attend an opening of an affordable housing there in Sacramento. So I think it's about 6 or 8 of our staff are actually at the grand opening of Anton Mosaic, a mixed income program development in Sacramento. Most of us have been to openings. We encourage, if you haven't been to a groundbreaking of an opening, please attend. We will coordinate that for you. But it was really cool, since we're all otherwise engaged this morning, to be able to send some of our staff, and they were very excited. I think they were like, some of them were nervous, like, what do I, so it was really cool. And, being a mission-oriented organization, it really is key to the staff to see how, the direct impact on people's lives that this organization provides and how we really do contribute to people finding a place to call home. So that's really, I'm so excited for their opportunity. And last, but certainly not least, I want to highlight for the board and officially congratulate Kelly Madsen, who's in the, where you can wave right there, yay, for being appointed by Governor Newsom as CalHFA's Director of Enterprise Risk and Compliance. I know firsthand Kelly has been with CalHFA, it seems like 5 years, but it hasn't actually been that long. And it seems like 5 years because the impact that she directly has already made to this organization, the positive impact, not only from a cultural perspective, a values perspective, but also from an operational perspective. And she's just stepped right into the deputy role that she previously held and just really just started swinging and making really great impact. And so I'm so excited that the governor recognized that impact and was able to appoint her as my successor. She has some big shoes to fill, if I want to be a little bit vain, but I only wear a size 8, so maybe they're not that big. And then that's all I have for you guys this morning. I think we have a really full agenda. I'm really excited for a lot of the topics we're covering today. Thank you, Chair Cervantes.
Thank you. I'd like to move us along. We've got agenda item 4, which I'm looking forward to an update on the mixed income housing program, or MIP. Stephanie McFadden, our Director of Multifamily Housing, will be at the dais. Your sister, and with Steve Gallagher. Thank you very much.
Can you hear me now? Okay, great. Hi, good morning, everyone. It's really exciting to be here with you. I'm Stephanie McFadden, Director of Multifamily Programs. This is Steve Gallagher. He's our Housing Finance Chief and has been since 2020. And we are here to talk about MIP, the Mixed Income Program. This has been a really successful multifamily lending program for CalHFA and the affordable housing industry in California. And today, we're basically going to do a state of MIP at CalHFA. Since 2019, CalHFA has helped to build 11,600 units through this program and created a really strong CalHFA portfolio along the way. This presentation is designed to be the start of a conversation. We're hoping to give the board some historical context on the program and to provide some insight into some of the internal and external challenges and opportunities. Please view this as a foundational piece of knowledge to inform you as board members as we bring immediate deals to you for approval, as well as when we start to think strategically about the future beyond MIP 25. This will start at the board retreat in March and will continue from there. Today is not that strategic discussion, but hopefully it will provide helpful context and history for that work in the future. As you know, the MIP 24 deals are in the final underwriting and closing process, and 8 out of our 13 deals are coming to the board for approval in the coming months. The terms and structure of those deals are fully baked at this point. In addition, we launched MIP 25 earlier this month, releasing the term sheet and application to the affordable housing industry. Those terms are baked as well. For me, as a newcomer to CalHFA, it's been super helpful to understand the history and growth and incremental changes that have been made to the program over time. We've accomplished a lot, and there is more to come. Steve Gallagher, our Housing Finance Chief, will get us started today since he was actually here at CalHFA when MIP started.
Thank you. Thank you very much, Stephanie. I was thinking about it coming in this morning, and my first board meeting that I attended as a member of the Multifamily Programs Division was the board meeting that MIP got its approval. And so we've just had our 6-year anniversary of the MIP Mixed Income Program, but MIP for those of us that refer to it every day. So I think, as the board knows, this was created with the annual appropriation of funds from 2017 Senate Bill 2, the Building Homes and Jobs Act. We get a portion of those funds that seed the funding for the MIP loans that we'd make. The slide that you have in front of you is showing some of the things that we set out to accomplish when we first launched this 6 years ago. At that time, the goal of the program, the focus, was we want to help the missing middle. A lot of the middle-income Californians that may not have had as many resources available to them. The loans were originally structured as 55-year residual receipt subsidy loans. The AMI range, which is area median income range, that was targeted was between 30% and 120%, and we had some preferences for projects if they had at least 10% of their units between 81 and 120. We also gave priority to developments with the lowest per unit subsidy request, and we, at that time, allowed the mixed income program loans to be paired with permanent loans from outside lenders. And on this next slide, you can see how the program has changed over the years, and there's a lot of change, and I think several of you hopefully have the handout that you can take with you. But there's been a lot of changes to the mixed income program over the years, and so I'll just run through some of the highlights. We won't read about every single one up there. Most of these changes are based on our experience. What we see is working, what's not working in the market as we have each round rolled out to the public. So the biggest change in 2020 was the infusion of funds that we got from AB 101. So that was in addition to the SB2 funds, which allowed us to provide more MIP funding for more projects. And you'll see on an upcoming slide that impact. In 2021, That's when we adopted the requirement for the MIP loans to be paired with the CalHFA permanent loan. That was done in part because we wanted to have CalHFA in first position on these projects and ensure that the spirit of the program was being followed. We also adopted an $8 million per project cap. I think when we got that infusion of funds from AB 101, we saw some projects that had very large MIP amounts in that year, which is great, but we obviously want to make sure that these funds can get stretched out and be used efficiently and go further. Another big important change in 2021 was the establishment of the mixed income pool at CIDLAC, which helped with access to private activity bonds for these projects. 2022 brought changes to the affordability requirements. We had a built-in requirement now where 10% of the units were available to very low-income residents. Now, we still had a spread of 40%. So we were saying 10% of the units must be at 30% AMI and below, but you had to have at least a 40% spread, so that meant it was a requirement that you had 70% units or higher. So we were still mixed income, units across the board for these projects. Then in 2023, I think that's when we probably had our biggest year of change. We adopted a lot of changes to the scoring requirements. We reduced the MIP amount per project to $4 million, once again trying to make these dollars go further. We also reduced the sponsor cap to 1 project per sponsor. Now, we did make some allowances for sponsors that would partner with emerging developers because we thought it was important to make sure that these funds be available to emerging developers as well. And we also updated the project rankings to more closely align with the CIDLAC and TCAC scoring. So we do have some, as I think many of you are familiar with, we have some ranking criteria boosts that CalHFA puts on top of the public benefit rankings, but primarily it's based on the same scoring that CIDLAC and TCAC uses. And then after our big revamp in 2023, we didn't make a whole lot of changes in 2024. We did bring back the very low income requirement, which actually went away in 2023. The reason that had gone away was I think there had been some focus on trying to get more to those higher incomes, get back to the middle income. But 2024, we thought it was important to still have that 10% of units for the very low income residents. So here's the slide that I referred to earlier where you can see kind of that big boost in 2020 where we got that infusion of funding and we had like large amounts going to certain projects. What you can see on this slide is just some of our high-level results. Stephanie talked about them in her introductory remarks. We've had 71 total projects, over 11,600 units, $1.3 billion in perm loans coming to CalHFA, and $400 million in MIP loans. So there was also a spike in production you can see on there in 2022. And some of you may remember that was the year that we made supplemental MIP available to developers. And that was because of just some market changes. Things were changing rapidly, and a lot of our projects that we were already underwriting had significant gaps. We were able, fortunately, we had enough funding, we were able to help fill some of those gaps with additional MIP. And that is why you see that number as high as it was, and also the per unit amount, because more MIP was going to those projects in that year. And then on the next slide, you'll see the amount of private activity bond volume cap that we've had associated with MIP projects, as well as the tax credits. Over $2.4 billion in federal low-income housing tax credits, nearly $3 billion in private activity bonds, and almost $700 million in state tax credits. And so this slide, the trend shows you, the orange is the state tax credits. The trend shows you just how important the state tax credits have become to the success of these projects with this program. Almost half of the total over half of the total state tax credits that MIP projects have received have just been in the last 2 rounds, just 2023 and 24. So it's become a very vital resource. And I know Stephanie will get into some stuff later about resources that are available to projects. And then this next slide will show you just kind of a picture, the map of MIP, if you will. The bubbles represent, the larger the bubble, the more projects there are in that city. We have had projects in 22 different counties across the state in the past 6 years. And I think, you know, I didn't get into the specifics of the changes in 2023 in terms of like what our project ranking adjustments were, but one of those adjustments was to have more diversity in the geography of our projects, to not just have all these projects focused in one particular area. And I think this map shows that that's been working. We've seen the projects get dispersed more throughout the state. Got one all the way up at the top in Crescent City, and then we've got, you know, a bunch, you know, down in San Diego, and you know, a lot of places in between. This next slide, it shows the affordability that I referred to earlier and the different AMIs, and I guess just how things have evolved. And I know the numbers are very small, and there's a lot of numbers up there. Basically, what you want to take away from this slide, the blue is 50% AMI or less, the yellows are 60 to 70% AMI, and the brownish color and the reds are 80% AMI and above. So you can see as the years have gone by, we've steadily gotten more of the low-income units, and we also have quite a few 60 to 70% AMI units. 74% of the total MIP units, in fact, have been restricted between 50 and 70% AMI. So that's obviously a huge percentage. And then, as you see on the slide, the overall AMI has been 56.9% across all projects, all years. And I turn it back over to Stephanie.
Great, and Jim, I'll let you manage the questions and flow here. Happy to take questions as we go. And Steve and I are here for the duration, obviously.
And I think what I will interject is that I saw a sneak peek of this late yesterday. It's a great presentation, and it's been very helpful so far. And Steve, thanks for walking through the history. There's a lot here, so I think maybe if individuals have questions, I mean, I'm okay just asking it if it's at the moment. I know there's the back end, we can do questions, we'll take public comments and questions too. But, you know, there's a lot here to chew on, so I think if you find something that you want a clarification on, that would be, I think, worth doing to have more of a dialogue perhaps. So thank you.
Sure.
Director Prince, do you have a?
I do. So I really just want to say thank you. I thought this was a great history. I also really appreciate the comment at the beginning of this isn't the time to get into the policy conversations. And so I just want to then ask some things to be thought about as we come back in March, right? I think there's this comment or goal about being good stewards with public funds. I really like to understand, have we been able to drive down cost per unit? Have we been able to, you know, what are the stewardship things that we've been able to do? And then are those replicable throughout the program, right? Really try to understand those. I would like to really think about the waivers. I know everyone knows this is my own issues around the waivers. I definitely think we have the dollars, and therefore we should be driving some of the terms and making sure we're in that seat and to be thinking about it. So I'd like to really make sure we do some analysis around particularly the developer fee waiver and the priority for that to be repaid. I would love to think about, and it's not here, but it has felt to me that sometimes a developer can bypass like local collaboration and be able to, you know, not necessarily, and locally, I think about entities that get city, county funds, housing authority dollars, that then kind of skip the traditional 4%, 9% routes and comes through the MIP program. And I get sometimes local requirements aren't necessarily the best, but I just like to think about like what's the role of local collaboration on the developments, and have we been creating a workaround so to speak? Or has it been?
I'm sorry, just to clarify that question, are you talking specifically about deals that don't get 4% tax credits?
No, I'm talking about
Okay.
ones that have City of San Jose, Santa Clara County dollars.
Yeah.
That don't get 4%, 9% tax credits, even though they're the local priority. But someone that doesn't have the local priority comes through CalHFA
I
and
see.
gets the allocation.
Thank you.
Yeah. And again, to me, that's really important to think about. There are local policies, not just about the dollars that are provided at the local level, but it's also community notification that some of the developers bypass because it's not required through the MIP program to have that collaboration at the local level. I think we can have all kinds of conversation about whether local control is a good thing or a bad thing, but at least be kind of cognizant about it. So I just want to kind of raise some things. I just want to see some more data as we come in so that we can really think about the great impact. And I know this is going to sound critical, but I don't mean it to be. I think that units would have been created through the traditional route of PAB 4% tax credits. And so, yes, 11,000 units have been created, but those 11,000 would have been, some number would have been created. So there's really a delta of what we have been able to do, either through the contributions of our MIP loan or by efficiency. And so I just want to kind of be cognizant of that and really think about what have we really changed in terms of the impact through this program. Thanks.
Thank you.
Yes.
Director Sotelo?
Yes. Just to elaborate on Director Prince's point regarding the his last point, I think that's critical, right? Because when we first started this program back in 6 years ago, right, the intent was about funding the missing middle, right, and projects that would otherwise have a gap created because there was no other funding source for those 81% to 120% AMIs. So in the data analysis that you present and the tables that you've presented are very helpful and the information is very helpful. But if we're going to have a strategic conversation about this in March, an analysis with regard to how the gap was calculated for the various 71 projects, whether that gap was a direct result of our requirement to have 10% of the units set aside at 30% AMI, or was that a result of no other funding sources being able to fund those 81% to 120% AMI units, right? Because there's a real correlation between that the scoring of the MIP projects doesn't really recognize now, right, because we've been through so many iterations, but the original intent was there is no other funding in California, tax credits, bonds, maybe, but no 9% credits that are funding that 81 to 120% AMI. So understanding the correlation between the policy objectives and how that money is deployed in the projects is a data-driven exercise that is difficult to assess given all the changes, but maybe we can help help you think about that before the presentation in March, because I think that information is going to be critical. And then to also Director Prince's point, this program isn't intended to be the cure to all evils, right? And it's trying to do too many things, I think, sometimes. So any data or any information that you can provide to us, and maybe you're about to go through this under the challenges, but if we can, as a board perspective, from a policy recommendation standpoint, prioritize for you what the objectives are of the MIP program and stay with those so that we're not curing all evils, right? That we're just trying to focus with the limited amount of resources that we have, the top 2 things that we need to do to achieve this, right? And again, being as flexible and as creative, as innovative as we want to be, how do we use this limited resource that's dwindling down to be the most effective in accomplishing those top 2 things?
Thank you.
Any other questions or comments at this point? Yes, Director White. Oh,
Steve had his hand up for a while, so.
Dr. Russell, and then Director White.
The loud part of it.
Come over here, Fred. Well, so first of all, thank you for the report thus far. I realize there's a couple points you're yet to make here. And I think the program has been clearly a great success, and I think it speaks well to the talent of the staff in doing really complex underwriting on these deals. So, and at the risk of throwing some more criteria out there, there's some things I would hope we could talk about in the March meeting. First of all, I'm going to be contradictory to Mr. Prince here, that local control has been a challenge, that folks wanting to throw, the requirement to do local outreach can actually add significant time and trouble to a project, to projects that are absolutely in compliance with local plans. And so I'm not going to, so I just want to put that out there.
I expect pushback.
Okay, good. So the other thing I think, I guess we're going to be getting to this, the idea of the supply, the demand being greater than the supply. I'd really like to understand the scope of that. How many applications are we getting that you are having to turn away? And that speaks to then the criteria issue, because if we have so much more demand than supply, we are in more of a controlling place in terms of what we're asking for folks, what kinds of projects we're looking for. And I will have some comments here in a subsequent item about locational criteria with regards to the state's greenhouse gas reduction efforts and building on the urban fringe at a low cost and the pressures that drive us to the urban fringe because of low cost versus our long-term viability as a society and where we build our apartments. So that's a conversation I'm hoping that we can have in the future. So, thank you.
Thank you.
Thank you, Director Russell. Director White?
If I could just respond real quick to Director Russell's question about how many we're turning away. So typically, each round, it's somewhere between 2.5 to 3 projects that we say no to for every one that we say yes to.
Okay,
So we're in the catbird seat.
thank you.
Thanks, Chair. So I'm a huge proponent of this concept, period, since I've been on this board. So I appreciate the board just intelligence in terms of putting something like this out there for the state. And I don't want to make this a strategy or policy comment, but that's what
We
we're
can't
all
help
doing.
it.
I mean, one of the things that I want to make sure that we continue to do is to move slowly, but move up that AMI spectrum. I think we've done a good job. You can see it, the changes. That graph there shows that we've been pretty thoughtful on how we move this up. Everyone over there said we don't want to be all things with this. And I think that's what, because it's so innovative, that's what we try. But we really need to come up with some priorities, top 3, and work with those. But maintain the innovation. I heard it in your speech, Stephanie, that's how you're thinking. So don't step back on that. That's what we're expecting. I'm the chair of the New Opportunities Committee, so reach out to us as you start to think these through. That's what we're there for. What else here? And as we start to lose or have reduced funding from SB2, definitely we want to start thinking outside of the box in how we can, quote unquote, raise capital for this innovation. And I am specifically not calling it mixed income program. I keep saying concept and just innovation, because we may step outside of kind of the naming to help us think a little broadly. So.
Thank you, Director White. Any other board comments? Yes, Dr. Kurgan.
Thank you. If I can just add one more to just mention is like something that we might consider in March. Promise not to get too far, Stephanie. Is just along this same time continuum has been many, many changes in state law that make it easier to fit projects in, particularly in infill areas, particularly with some amount of local control, but that is often like a non-discretionary process. And so just in terms of raising the bar, raising expectation, and making sure that CalHFA has the type of ongoing connection and resources with the Department of Housing and Community Development, who works on a lot of the enforcement of that law. There's a lot of things that are by right now that weren't by right in 2018 or even 2020. And so to the extent that we're considering our expectations in balance with what is possible, and then making sure that people are aware that the whole state team is kind of working together on that. I think that's just something that I'd offer by way of both the ability to decrease cost through predictability, still in conformance with local plans. So I think I'm trying to go for a tweener between you two, because both can have challenges. And then also just to name the dynamic nature of the lending environment and federal resources that we're in right now. So I think our ability to stay flexible and mindful of a broad array of needs. And I hear you, Director White, and agree we still have a great need for housing at higher ends of the spectrum. And the biggest risk that we see of people falling into homelessness are below 50. So there's a balance there that we can strike to make sure that the projects can stay sustainable, and also that these projects can serve to act as prevention, not just at addressing homelessness. And that is could be really helpful when we're thinking about, really broad economic impacts. I won't get us too deep into federal discussion, but just to say that plainly. Thanks.
Thank you. Okay, any other board comments, questions? Yes, Director Russell.
Just very briefly, I have heard with regards to SB2 that there is a renewed interest in revisiting the formulas there and increasing the revenue available through that. So we should be sure that, I'm sure Meiji is here, make sure that we're tracking those efforts and rallying allies to help us increase the pot of money that's available through that means.
Thank you. Good point. Okay, I'm looking around. So, Stephanie, you're barely out of the starting block here, but the board is already
Fine.
like kind of throwing.
I mean, we're doing the best we can, right?
There you go. So please, go ahead.
Great. So as you've already noticed, we have challenges and pressures here that are internal as well as external market and developer-driven challenges. Internally, we find we are needing to balance our primary goal of building units now with available subsidy dollars versus our desire to preserve and recycle these subsidy dollars over time. Subsidy is a scarce resource, and it really does close the gap and allow affordable housing deals to go forward. But if we attach too many strings, we may find that developers choose not to move ahead with those deals. This is one of the things we need to think about is what kind of subsidy lender are we? Are we a 55-year lender or not? So yes, I am seeking board guidance on a lot of these topics because it would help us to frame our decisions going forward. And as you can see, it's sort of moved around over time. So that being said, there's a deep well of demand for subsidy to close the gap. Costs continue to increase. Affordable deals are harder to close. There are fewer resources available to these developers. And what we're experiencing currently with SB2 is that those revenues are going down. So I am excited that there's an opportunity there. And I will also just note that in the market, developers think we just have this money. They don't really understand how dependent we are on SB2. But that's on us to communicate a little better. By pairing MIP with CalHFA permanent loans, we've built a robust portfolio of fiscally sound loans throughout California. In the next 5 years, the CalHFA portfolio will basically double in size to $3 billion, primarily due to these MIP projects. These deals are on average bigger than our current portfolio deals, and they're primarily insured by FHA through the risk share program. So it's a strong portfolio, but it's different than what we have right now. This is a strong business driver for our multifamily program, and it is fully dependent on the pairing with the MIP subsidy. We would not get these permanent loans but for that MIP subsidy. This is just part of our multifamily program overall. We have a strong conduit bond issuance business and a lot of opportunity on the bond recycling side, but neither of those have produced earning assets on our balance sheet in the same way. So this is something that we'll be considering as we move forward into fiscal 25-26 and seek to create new multifamily lending products to round out our offerings. So more to come on this. It's just one of the context pieces that I know I'm looking at closely. Despite the critical need for affordable housing, the industry is experiencing serious headwinds. Lack of resources that we've all noted. There seems to be decreasing pricing from tax credit investors, which is a key piece of these deals. And specific to our program, this year we have fewer state tax credits available for MIP deals. In addition, there are simply market issues that are resulting in increased costs from materials, from insurance. There are delays in putting together these deals that cost money, and there are material shortages and delays as well. Luckily, we have a strong set of financial underwriting policies to address these issues in our underwriting. You do see exceptions to these standards. As the markets change, we need to be flexible and supportive of these changes in the industry, and we mitigate these exceptions in a way that protects CalHFA. So, here are the three most common exceptions. You're going to see this first exception 2 times today in the 2 deals that we're bringing to you. We see this a lot because many localities offer density bonuses and document them in this way. We believe the standstill agreement protects our rights as a lender and recommend approving these exceptions. We may, as we look at MIP 26, make this a standard that does not require special approval and mitigation. But for MIP 24 and MIP 25, you will continue to see these exceptions. The next 2 are related to our treatment of the residual receipt payments on the MIP loan, as well as our requirement for repayment at maturity. We typically require that 50% of residual receipts go to pay our loan, but often the tax credit equity partner requires that the deferred developer fee be paid off as soon as possible, and certainly before their exit at year 15 from 100% of residual receipts. This is to avoid serious tax consequences for the partnership, to include recapture, and we recommend approving this exception when we've received evidence from the documentation that the equity investor has made this a requirement. I'll just note that this 50-50 requirement has been an exception, and then not been an exception, and then been an exception again, and so it's still an exception for MIP 24 and MIP 25. We attempted to give ourselves a little more room to make this not an exception, so because we're seeing it so frequently. When this happens, we find that when we get to loan maturity in year 17, the likelihood that the borrower will be able to pay us back 100% on the MIP loan from the proceeds of a refinance at that time goes down. We always do a very conservative exit analysis that makes assumptions about the increase in interest rates and the increase in cap rates, and frequently find that the math shows that the MIP loan cannot be repaid in that scenario. To mitigate this, we require that the developer commit to repaying the MIP loan from a general partner contribution. We think this addresses the risk based on our conservative assumptions in that exit analysis. So you'll see that also, I'm sure, in the coming months, but not today.
So Chair Cervantes, this would be one of the critical issues from a policy discussion in terms of how we review and make exceptions to this regulation. It's I'm being a little careful with my words here because it's a big deal for the developer community, but it's a big deal for us as well because we want to be able to have a discussion about whether we want to recycle these dollars or not sooner than not. And so if I can ask staff to bring a little bit more data to our discussion in March that quantifies for us the average developer fee that the 71 projects has actually, that they've realized in the context of whenever we've waived this or whenever we've accepted the exception, just so that we can see the volume of developer fees that developers are getting relative to the amount of money that we're loaning. And then the other thing that I'd like to see is the mechanism, and maybe we need to explore this a little deeper so that everybody on the board understands this, but it's not that the investor, is threatened by the recapture of tax credits. It's that in order to count that developer fee into basis, it needs to be paid out within 10 years, right? And so there is just a physical, inability to repay that developer fee in 10 years for some projects, and they will experience that recapture anyway. There is a way that we can prioritize or allocate the repayment of our loan in that context. And so it's not necessarily all driven by the limited partner. And oftentimes developers use the shield of the limited partner to negotiate, a better transaction for themselves. I'm a developer, I know from whence I speak. So I think that we just have to be mindful and maybe look at the data a little bit more as we make recommendations about what our strategic objective is here.
Yeah. Thank you, Director Sotelo.
And I'm only talking, there's developer fees of like 11, and like the developer fee here is like $11 million and 50 million. I mean, it's a lot of developer fee, right? So I don't begrudge developers for making a fee, but we're a public agency and we're stewards of a public good.
And we're following the CIDLAC TCAC guidelines on developer fees. We're not creating our own. We're following the other state agency guidelines.
Yeah. Thank you.
I just want to point out that we did a closing and we had the opportunity to push the developer fee as the developer, and we didn't, right? And so I think that there is a good role of stewardship that matters. And so I'm not asking for someone to do something. And I know I was questioned, was I a real developer? I've done 50 transactions here in California over the last 15 years, 9% and 4% deals. So yes, I'm a developer. And yes, I do not maximize my developer fee. We have the gold. We can control this a little bit.
Okay. Thank you, Director Pitts. I will always never say that you're not a developer on that one. Thank you. Any other questions, comments at this point?
One question on the third exception. In terms of the underwriting for the exit analysis, is that like really stringent conservative in terms of the criteria you're using to show that they, I don't mean to put you on the spot here.
So typically what we do is we increase the interest rate by 3% and the cap rate by 2% when we look at it.
Okay. And in terms of the mitigation part of this, is that a covenant of the loan?
So yeah, it's
It becomes
put
a
in.
covenant?
It's part of the docs. Yes, that they sign. Yeah.
Thank you.
Thank you, Steve.
Other questions?
Yeah, I actually
Russell.
do. Just a quick one. I guess I'd like to better understand maybe when we talk in March about how the equity investors are able to drive these terms and what leverage we have to push back. Because if this, either we have to say this policy needs to change because we're accepting it all the time, accepting with an E, or we need to assert ourselves in ways to meet our actual policy goal that we've stated thus far. And so I guess I'd like to understand better where we have leverage in that conversation.
Great, thank you.
I just say thank you for, you may feel like you're being bombarded today. You're doing wonderfully, and I thank you for the work, and we're just trying to do our job here.
I wish
No
I had
problem.
said that too.
Stephanie, please go ahead.
Rebecca?
Yeah, I do think though this is, while we're not having a dialogue, we just wanted to get the feedback and get the things on the table and the big questions that we want to look at. That was the point of this kind of level setting for the board. Everyone has great depths of expertise, but not everyone is a developer. So we wanted to try to level set for the board. And so if it doesn't make sense or you have big questions, that gives us the opportunity to collect the data points that you guys need to be able to make a more fruitful conversation. But we will re-agendize a conversation in the next month's meeting, specifically on this topic as we do. Just want to reiterate the timeline that Stephanie's kind of there. We would be looking to be making major policy changes for the MIP 26, because MIP 25 term sheet has been posted. Okay, just making sure.
Thank you for your support.
As had been said, that cake has been baked.
Indeed, fully baked. Great. Okay, so this slide is here to give you an idea of how long it takes a deal to get to closing, given the CalHFA underwriting and approval process. We do find that planning around a monthly board meeting adds a level of complexity to our deals and can often add 3 to 4 weeks to our turnaround time. Often these deals are delayed for reasons outside of the developer's control, and we strive to meet our closing deadlines for them because of that. That requires flexibility on the part of our internal senior loan committee and also from Courtney and Melissa as we finalize materials for the board, so thank you. In my experience, 60 days from the start of underwriting to approval is not terrible, but 90 is too long. And 30 days is certainly preferred by not only developers, but also lenders, so that you can actually, stick a fork in it. Part of the problem that we have is endemic to this industry. These deals are changing all the way up until the closing date. We are getting new numbers midway through our underwriting on the regular. It happens all the time. So it makes it challenging to sort of pick the start date, right? And make sure that we're not squeezing our underwriting time too much. In my last role at a nonprofit CDFI, making loans for multifamily affordable housing projects, our credit officer met with the team 2 times a week to approve deals. And in the course of a year, we would bring 2 to 3 deals for approval, not by the full board, but by a board loan committee that was delegated authority by the full board, out of a total of 50 or 60 deals that we did a year. So 2 to 3 to the board committee out of 50 or 60 in a year. The remaining deals were approved by the delegated authority of the credit committee made up of CDFI staff and the credit officer. So it's, there are different models for how to address this timeline challenge. Right now, for MIP 24, we are in the thick of it. We have deals that we're looking at here in February that have a closing deadline per CIDLAC in May, and we're not sure we can get it done because we have to come to you in April. Anyway, it's very hard. And I just wanted to sort of give you a little bit of an insight. This is just a sample of this is what the deal that you're seeing today, this is what its timeline was like. So just as an example. Okay. Oh, Steve has something to add.
I just wanted to add one thing, because what's not reflected on the chart here as well, Stephanie mentioned earlier how all of our deals are insured through FHA risk share. There's also a process overlay on top of this that we have to follow there. So I just want the board to understand and appreciate that there's federal requirements that we need to comply with in order to get the firm approval from HUD processed at the same time as closing.
So I'll ask a question since I'm not a developer. So if you overlay that plus our process, is that in this 90-day frame?
It's happening simultaneously, yes. But there's different steps that must, I'm just letting you know that there's steps that must occur that you don't see in this chart here, that we also have to get approvals from HUD.
That makes sense. It's a critical path analysis somewhere along the line. So I guess theoretically, if we squeezed it down to 30 days, it might not matter. I mean, I don't know.
There certainly could be situations where the federal noticing requirements take longer than that 30 days, right? And even if we try our best to plan ahead and get things organized earlier. So there's a lot that we're juggling and a lot that the developers are juggling at the same time.
Okay, thank you.
Right, but just to clarify, the risk share process is triggered not only by, the analysis with HUD is not only triggered by our risk share, but by the tax credits, or like a project-based voucher program. No, it's only for our risk share.
If there are project-based vouchers, yes, there is that process going as well. But no, for the risk share, that is triggered by us submitting to
Okay.
HUD for.
So it's not a subsidy layering review process. It's a different one.
It's FHA insurance on these loans.
Right, right.
So we're getting, because we're doing the perm loan, we're getting that insurance. So we have to do certain things.
And so Stephanie, that's the operative piece, right? That at some point, the board made the decision
Yes,
to marry the MIP funding with our permanent loans.
yes,
Before, they were disassociated.
correct,
Now they're required to be connected.
correct.
So from an analysis standpoint, it helps us, right? Because we are providing a bond product to the project, and we're able to increase our bond productivity out there and,
For sure.
sustainability as an organization
Yes.
and using our funds to do it. But it is a dynamic that we created ourselves by making that requirement.
And choosing to lend only risk share insured
Yeah.
permanent
So they're
loans.
policy decisions that are driving this dynamic.
Great point, thank you. And Stephanie, thank you.
Yeah,
Can I just, because you mentioned vouchers a couple of times, I would love to know like the ratio of vouchers, project-based vouchers within,
Sure.
within it as well, just to understand that leverage.
absolutely, yeah. Okay, so this is my final official slide. And this is the good news of this month, is that we launched MIP 25 earlier this month, which is super exciting. We have issued terms for these loans, and we've made some changes to the program. You can see the timeline is that we are expecting applications from our developers by March 10th. We will then internally rank those projects and announce awards in early April. This will keep us on track to submit for SIDLAC's round 2 allocations. We did make a couple of changes. Some of these changes include making it easier for LA County deals to qualify for MIP and not be restricted by the county cap. This is to provide assistance in the region affected by the fires. Because we had a lower amount of state tax credits available for MIP 25, we removed the state tax credit leveraging bonus from our ranking criteria. We added an aggregated exposure cap for sponsors that have MIP projects in the pipeline, still in construction, to make the subsidy more broadly available. And we have some minimum and maximum requirements for the TCAC aggregated basis that we're hoping will reduce the amount of supplemental bonds that are ultimately needed by these projects. We anticipate the program will be oversubscribed again. We'll know more in a couple of weeks. And we hope that these projects will be coming to the board at the end of 2025. Although, given this year, it could be early 26, so.
Just had a quick question. If we're oversubscribed, why would we be eliminating the bonus for the credits?
Because of the reduced amount of credits. So if we're incentivized, if that incentive is in place to give you a boost if you're using more credits, but there's fewer credits available, that's going to drive down the amount of projects that we can actually provide funding on.
Right, but we're oversubscribed.
But almost all the projects require state tax credits. So when we look at it every year, we're kind of looking at the bond cap, the tax credits, and the MIP, and what is going to run out first when we do our rankings. So that's because we want to do as many projects as we can.
Of course.
So last year, I believe it was the state tax credits. I'm going off of memory, which could be dangerous, but I believe it was the state tax credit cap that we hit first. So that's why we have 13 projects this year. We had enough MIP that we could have done another project, but we didn't have a project available that could have moved forward with the amount of bond cap that was left. So we removed that leveraging to hopefully reduce the state tax credit requests, thus making the projects go further. That's the hope.
Got it.
Thank you. Sort of a chicken and egg thing, it sounds like, you know.
Indeed, yes.
Are there other? So you're through?
I'm all done. I really appreciate all of the conversation and feedback. I think it's going to be really helpful. I am hoping that the board can provide some clear guidance on what the 1 or 2 or 3 priorities are for this program, because I think there is a huge opportunity for us to use this in a really meaningful way. We just need to decide what we want it to be. Right. And I think we have some really great information now to make that decision.
Okay. Are there other questions or comments from the board? This has been a really robust discussion or interchange here.
I have
Director
a
Williams.
question. Related to the county caps, how often have we maxed out or even come close to county caps, and how are those caps determined?
So we haven't actually had a project not get funded because of the county cap yet. But the idea is, let's say the top 6 projects were all in one county, but we don't want all of the MIP funds going to just that one county. So it would depend on what the amount of MIP request is. I believe it's 25%, 20% or 25, I'm sorry, I don't remember off the top of my head, but it's 20 or 25% of the total MIP cannot go, more than that cannot go to one county in a given round. But, as Stephanie said, for this year, we are exempting Los Angeles County from that county cap. Now, the projects still have to rank. It doesn't mean that just because you submit a project and you're in Los Angeles County that you're going to get funding. It's still going to go through the same ranking process that everybody else goes through. But in that scenario, that hypothetical that I outlined, if the top 6 projects were Los Angeles County, then theoretically, we would move forward with all 6 of those, and the cap would not apply.
Okay, thank you.
I just want to highlight on that, removing the cap for the LA County. While we're wanting to be supportive in recovery efforts, realistically, we probably won't be seeing many of because the developments have to be in a certain stage to apply, and the application window is open now, we probably won't be seeing any kind of direct impact from rebuilding efforts until starting MIP 26, maybe more MIP 27. So just from a timeline perspective, we want to be open and ready to help the rebuilding efforts, but just setting expectations for the board in the current round that's open. The project would have already had to have been conceptualized and gotten to a certain point prior to the fires even occurring.
Right, but to the extent that any housing built in Los Angeles
Yes.
helps the pressures associated with,
Yeah.
and exacerbated by the fires, this is a good priority for us to have.
Yeah, and we're very supportive. That's why we made the change into the MIP term sheet. But I just wanted the board to understand that also, we'll be seeing these rebuilding efforts coming through in LA County probably in the next years to come, and so that we would want to make sure that we're talking about policy and setting priority. That'd be something for the board to consider.
Right. And so may I ask, the changes that were made to the 2025 term sheet, those were, I may have missed it if they came to the board for approval. Were they approved by the board, or they just were done through staff?
No, these were staff level changes based on what we saw in the program in the prior years and what we're trying to address in this round.
Okay, so I guess from a general standpoint, to the extent that at the retreat we can talk about the dynamic of how modifications such as these have policy implications in terms of how the program works, and whether that's done at the board level, at the staff level.
Yeah.
And then the last question I have, just to ask for more data is, can we look at the average unit size, the average unit count for the projects, right? Because it seems to me, and it's anecdotal, but we seem to be getting a lot of large projects being funded by the MIP program as opposed to the smaller projects. Oh, that's a good idea. That's a good breakdown.
Did you
Yes,
guys
please.
pick that up? Sorry.
Sorry about that, total units and then total restricted, which I think just to kind of float this, not to get into it, but just that opportunity to buy down affordability in projects that are moving and to think about that opportunity to kind of get projects over the finish line could be something that the board discusses and priorities that would apply there.
I have one last thing, because Director Kerrigan brought it up in my mind. I think that, and this is industry-wide, it's not the MIP program, that as we develop units at like AMI levels, that there is an inherent rent burden for the families within the units. And particularly, even at 30% AMI units, if there's not rental assistance, say a senior coming in is making like 10% of AMI, and they're many times, I know in Santa Clara, they're paying over 100% of their income towards rent, right? And so I'm kind of curious, I don't think it's just the MIP program, it's really our entire program. And as we have conversations around social housing, trying to think about like, what's the real kind of burden that someone should be paying and how do we get there, would be of interest to me. And so I don't know if there's a way to look at like, what's the actual rent burden within the portfolio? And again, I think it's like industry-wide, so it might just be a little out of bounds for this particular conversation next month.
Thank you, Director Prince. Other comments or questions from the board? Before I go to public comment, so I guess for me, thinking about MIP in the long term or whatever, maybe we even rename it, who knows? But, we're in a shifting landscape. So we've talked about SB2 funding going down, question mark on the state tax credit. Who knows what's going on at the federal level? But some of the pillars that we sort of relied on to create affordable housing with tax credits and so on, I'm not sure we can rely on those going forward. So it kind of begs the question like, well, we can't be all things to all people here, but if you stress tested the model to say, okay, let's assume we don't have state tax credits anymore, or, federal tax credits for that matter, what does that do? And my hunch is that, or intuition is that we've got to move up that AMI curve. It's no longer going to be 56.9%, or whatever that figure was. I don't know where it would be, 85. But like, could we create a program that sort of addresses the need of, people in the state still, maybe not as further down the AMI curve, but have something that works to provide housing options if we can't rely on some of these other programs that have been, again, part of the foundation of what we've been doing or with what the industry's been doing for housing. I'd be curious to get a sense of that. Because we do have, our superpower, using, as someone once said, we've got ability to sell bonds. That's a plus. We do have balance sheet. That's a plus. We deploy balance sheet to sort of augment that bonding capability to get somewhere. And maybe that's combined with fused with MIP, or I'm just trying to think of like, how do we play all this out in a landscape that's shifting and really shifting in a bad way, honestly. So I think that may be a thread in the discussion, because I'm thinking like how do we create something that works going forward, and maybe understand that there might be trade-offs there with respect to the percent of AMI we're serving. So just thought I'd throw that out there to chew on.
Well, I definitely think that there's a goal about this idea that you can cross-collateralize within the development if you're serving higher income to serve the lower income, and try to figure out how to create that subsidy or that ability to serve the lower income. But again, just pushing the income levels up higher when we're using tax credits and bonds that, I get bonds are, you have sunset provisions, our goals, our requirements of 40% below 60 or 20 below 50. But we're using the tax credits and other dollars that are supposed to be serving the lowest income families. I know I questioned the economists a couple of years ago here in this room, and as our median income levels keep rising, my question was, is that, does that also represent the actual households? And the economist said yes. And I can say unequivocally that is not the case in Santa Clara, that the lowest income households' incomes are not keeping pace with median income increases. So if we just start going to a higher median income unit, we're going to be leaving more and more people behind, or making them more and more rent burdened, more and more homeless. Right. Then we lead to the spiral downwards. And so I feel like we have to have a real conversation about the housing that's being built. Is it serving people? Is it leading to stability? Is it leading to other outcomes, not just a unit built?
No, I think, Director Prince, thank you. It's a point well taken. I guess I'm just thinking, I don't know, maybe an aspect of humility here. We cannot solve all the problems with this one program. And if we are in an environment where some of the tools we've relied on just aren't available, what do? We got to do something. Any effort adds value, I think. And ideally, I think would be, maybe you have a weighted average percent of AMI where, in effect, you do get higher income households helping to subsidize lower households. Maybe that's part of a policy objective we've got. But I'm just kind of curious, again, you start to pull out some of these other pieces, what do we got? What can we do using our ability to bond and maybe our balance sheet? Dr. Corrigan.
Yeah, I think these are really good questions. And as you were talking about cross-collateralization and mentioned social housing, which I promise I'm not going to spin off on, and you're talking about, getting higher incomes in, it might be worth us evaluating the spread and the 40% spread that you've been looking at, and what does stretching that do for the ability to be more receptive to other novel types of funding and be able to be nimble in the way that the chair is describing. Yep. And so I think there's a bunch of levers here. That is a word that CalHFA has used in several programs to be able to iterate. And I think your ability to read the policy room and the financial environment for MIP 2025 is evident that the staff are already thinking about ways to do that. So very excited to hear your ideas and consider options. I think your point on nimbleness in a time when we don't know how to make sure that the program can move appropriately given that dynamism.
Can I just say two quick things? Oh, do you want to?
Just
Yeah.
Actually, maybe in response to that, and then I'll get to your comment. Okay. If you have a response to this, please.
I mean, I just want to give you guys a little bit of an insight into the things that I know I'm thinking about, and I think our whole team is thinking about. We are having conversations with a developer who builds affordable housing but does not use tax credits. Mm-hmm. And I want to figure out how to get that guy a MIP loan. Mm-hmm. So we're talking to him, and we'll see where it goes. Mass Housing is doing some super cool stuff right now that I would like to share with you all. It's called the BUILD program, B-I-L-D, and it leverages a statewide requirement that market rate housing, no matter where you are in the state of Massachusetts, has to have affordable housing as part of that development. And this program includes a mezz equity piece and a forward commitment for permanent financing through Freddie Mac. Super interesting. So I want to just to let you know that I'm thinking about a lot of these things and trying to explore what's out there and what people need. So more to come on this. I really invite this feedback. So.
Yes, Director.
Gotcha, thanks. This wasn't what I was going to say, but based on what you just said, feel free to reach out to the New Opportunities Committee.
Great, will do.
With those types of innovations. But what I was going to say is I'd like for you in a future presentation to share everything that CalHFA does in terms of multifamily.
Sure. Mm-hmm.
And it'll outline where we are on the AMI spectrum. Because we are narrowing in on MIP when we do so much more in the multifamily space. So I want to have that context as we have these discussions.
Great, thank you.
Okay. Any other comments,
Steve
questions
had one
from the
thing.
board?
I just wanted to mention to the board that so we went through the slides. We also have some exhibits attached to the slide. We're not going to go through them here, but there's supplemental information about what we talked about, gives you just a little more detail. And Director Prince, one of those slides was in there as a direct result of your request at the last board meeting. So it's based on the project that the board approved, Holton, Maine. You would ask for like a case study to be done. So there's some basic information in there. Hopefully you'll find that helpful.
Great. Okay, then I think I will ask, Melissa, if you could see if there's any public comment on this agenda item.
We'd like we'd like to offer the opportunity to the public now to make a comment. Are there any members of the audience that would like to make a comment this time? We have a hand raised. If you'd like to come up here by the microphone, thank you.
Hi, Rob Morgan with Trestle Build. We're an emerging developer in San Diego and involved with the project that's before you here later today, but I was listening in and just thought I'd share a couple points that resonated. One about looking at the 80% to 120% AMI. One of the biggest challenges we have as a developer is that 80% hurdle is very high because that's where tax credit equity and the LIHTC program fades out, and also where the statewide real estate exemption fades out. So if that can often add $300 to $500 per month in rent, translates to about $50,000 to $100,000 of subsidy the moment you trip over that 80% wire. So something to keep in mind of the way other resources we use, and that threshold is particularly important for affordable housing. And then the other thing, I love the thought about getting clarity sooner and driving towards policy objectives. One of the biggest challenges we have in our business is trying to put projects together that can align well for the programs that are out there. And so I would just encourage you as you go through this process, the sooner you can drive to clarity, give staff direction, and then ultimately communicate that to the larger development community, the more you're going to see the types of products you want. One of the challenges to date has been, the new term sheet comes out about a month and a half before, and we have a sense of what that's going to look like. But the more time we have to know, then it would be much easier for the development community to respond with the types of opportunities you're looking for. And then the last thing I'd mention is just what we see in the marketplace, and I'm not educated enough to know the why, but the perm loan interest rates we see compared to just the open market are about a 25 to 50 basis point premium over what we pay. So just realize that that could be still a good policy thing for your organization to have, but there is a little bit of a spread we see in our projects that are burdening those products a little bit. And I think there's offsets with the program and lots of other things, and some really good things that your program can do organizationally, but just recognize there's some tension and trade-off with what we see out there in the marketplace. So thank you.
Great. Thank you very much. Can I get your name again, please? I'm sorry.
Yeah, Rob Morgan.
Great. Rob, thank you very much. Appreciate the input. Any other members of the public?
Are there any other members that would like to make a comment now? No hands are raised.
Great. So I think I'm going to give the board one last shot. I'm looking over at you, Director Prince, to see if there's any other comments or questions. I'm really excited about this. Yeah, and I would, thank you both very much. It was, as you could tell, a lot of board interest in this topic, and I think it was a really great overview you provided us. Appreciate your sort of working with us as sort of like ferreting out some additional information that will be helpful, and I'm definitely looking forward to the conversation at the workshop. I think it'll be very, very helpful. So thank you both very much.
Thank you for your attention and engagement. Yeah.
Okay.
We're going to stay here, I think.
I think you're going. I think you will stay here because agenda item 5 is the final loan commitment for the Masons Village project. So please go ahead.
Great. As previewed, this deal is coming to you for approval because the permanent loan is over $15 million. It is a 191-unit family project in Palmdale, Los Angeles. It's phase 2. We also financed phase 1, which I understand is 100% leased and fantastic. This transaction, we will have a $30 million permanent loan, and the MIP subsidy is $1.6 million. The total development cost per unit is $369,000, which is quite low, like kind of amazingly low. In this case, we do have one exception to policy, also as previewed, related to the density bonus agreement. In this case, the locality is adding regulatory agreement restricting 10% of the units at 60% AMI, and in return gave a 20% density bonus, some waivers on design features. So we are looking for your approval, and I'm happy to answer any questions.
Thank you. Any questions from members of the board on the project or the approval?
I have a question.
Yes, please, Director Williams.
You referenced the lower total development cost. Could you highlight any factors that have contributed to that? Because across the state, we're seeing substantially higher costs, and that could be something that we continue to see. But where there is the opportunity to highlight how developers are reducing their cost, is it design? Is it the cost of the land? Is it they got a great contractor who gave them an incredible price? What are the elements that have contributed to this, particularly seeing that it's in Los Angeles County?
Right. Luckily, the developer is here today. My sort of high-level answer to that question would be it's likely building type in this case, as opposed to building sort of up, which is very expensive, right? But I'd like to turn it over to the developer to give you a more detailed answer.
All right, thank you.
And as the developer comes up, I'll note that this is my question. It's like, what's the secret sauce? So thank you for being here. And just please introduce yourselves.
Chair Cervantes and board members, my name is Kevin Harbison. I'm the Senior Vice President for Ravella Holdings, or the applicant.
Chair Cervantes, California Board. Pleasure to be here. My name is Phil Ram, Principal with Ravella Holdings.
Yes, and to answer your question, sir, there's a few reasons. One is land basis for sure, and Palmdale is quite low. But we're also building type 5, two-story. We're utilizing California State ADU law, and we're adding additional units to our lots in the form of ADUs and JADUs. So we're densifying to about a 9 to 10 unit per acre, where the zoning would be, lower than that. And that allows us to build at quite a low cost.
Is it the ADU, is that just for a single individual, or what's the target for family size for the ADU?
Sure, so the main home units are 3-bedroom, 2 baths. ADUs are 2-bedroom, 2 baths, so we're putting families in those as well. And then a JADU by definition is a 1-bedroom below 50 or 500 square feet.
Yeah, okay.
So if I could help try to visualize this. So you've got a lot, you've got a 3-bedroom, 2-bath home on it, and then behind that, you've got an ADU. That's part of it. So if I'm stepping in to buy this, I'm buying that package. Is that?
Well, these are all rentals, so, correct, but basically, you're right. And then attached to the main unit is the junior accessory dwelling unit. It has to be attached to the main unit. And then we interlock the units with various paseos to make it a more communal, walkable community, because we own all lots, we can do that.
Right. So on a given parcel, then you could have one family in the 3-bedroom, 2-bath home, another family in the 2-bedroom, 2-bath ADU. In the junior ADU, you could have another individual as well. Is that?
Well, sometimes we see, single parents with children in the 1-bedroom. But yes, typically that would be the makeup of the folks we see in the units.
Okay, interesting. Yes, Director Russell.
First question, I guess, is does Phase 2 then look a lot like Phase 1?
It's very similar. The only difference is this is our first foray into two-story main product. The lots are a little shorter, so we had to go up another story. We like to build one story when we can, when we have enough land.
So I'm just going to raise this as a good example of the kinds of projects that have bothered me in the past, and it's a critique of building sprawl. We're building single-family homes on the very most outer edge of the urban area, and that, from an environmental standpoint, one of the considerations in our reading is the green characteristics of the buildings, and clearly you're doing solar, you're doing insulation, you're doing all the things that the highest level of code would require. And yet, it is our experience in the architectural and urban planning realm that all of the best environmental things you can do on a building can be completely negated by the location of the actual project. And so I'm torn on this. I don't want to scuttle a deal that's at this stage of development.
We're not doing that.
But I can't let go an opportunity to show an example of this is, if we're actually going to be following the environmental goals of the state, that building on the urban fringe is not going to lead us in that direction. And so I need to put that on the record, and I hope when we talk in March, that this will be one of the things that we consider, is whether this is the best investment of public resources to further extend ourselves out into the desert. And I think I'm going to stop there.
I did note, I looked at the map, I mean, it's surrounded by development, if I look at the map properly.
It is surrounded by development.
I know it's Palmdale, so it's further out there relative to like the
And
San
it's
Fernando
considered
Valley.
low-resource area.
Yeah.
And so my concern is, I drive out, I drove to Fresno this last summer, and my soul screamed at the sight of this urban sprawl, because the actual, I'm not going to get into that any deeper, because that's not the issue today. This is an example of not best practices in urban planning and development. And it's bigger than you guys, by far. It is that whole community. The question is whether we're putting our precious resources in doubling down in a way that does not advance our state's environmental carbon reduction goals.
It's access to transit, it's access to jobs, access to medical facilities, that kind of thing. It's not just other housing development that's being built.
Yeah, and not to get in a big debate here, but, also there's a community in Palmdale it's there. It's a lower income population. There's a need for affordable housing. My guess is that just given that you're in under $370,000, you're probably able to provide pretty attractive rent levels to a population that has real need for that, just given the community, so.
Yes, sir. And if I can speak to because I understand the concern with this type of development when we're working hard to reduce greenhouse gas. And we did do a greenhouse gas reduction plan. The city of Palmdale with high-speed rail, and there's a Metrolink station, they're bringing more jobs to the city. I mean, Palmdale and Lancaster for a long time have been a bedroom community for LA. But now you're seeing a lot of industrial jobs moving up into that area with the Inland Empire being tapped out. So I think that, we're actually working with the city of Lancaster on hydrogen power. We're seriously working to try to make one of our communities hydrogen power. So we are very sensitive to the concern of being an emitter, especially in an urban environment or in a more suburban environment like we are. And we try to do the best we can with overcoming that to the extent we can.
And I just want to reiterate, because of this is the final approval, I am not going to be a part of trying to sink a deal at this stage. I would be remiss, though, not to use this to identify an example here. And so I will be supporting this, but please understand where I'm coming from with my yes vote.
Duly noted. Thank you, Director Russell. Any other comments or questions?
A quick question around the capital stack. Are vouchers involved in the project?
You want to speak to that?
Yes. To just, as Stephanie mentioned, this is a second phase of another development. The adjacent development was 170 units. We went to market about a year ago, and we had 1,000 applications. So I did a lot of research and looked at all of those applications on where our residents, our applicants were coming from. And most of them were from a 5-mile radius of that location. I then further looked at some of the addresses where these families were coming from. Some of them were, there were 2-member families. Some of them had 4 children. And they were living in homes that were obviously, 2-3-story walk-up, and they were built in the 70s. And some of them didn't even have air conditioning. There were unsafe, homes, and kids were there. So it really makes us feel good that we can provide new quality housing for residents who are within that area. And this is Antelope Valley, I think, has 600,000 residents population, and the job market is really growing. So it really does make a big difference on people who are in that local community. So we're a very specific type of product which suits that particular market, and we're very delighted and pleased that you support our project, and we can help these families.
And Phil, I think you got the question on vouchers?
Yeah, the vouchers are there vouchers a part of the project?
Section 8 vouchers.
Sorry?
Section 8 vouchers.
Yes, we do. And we've had several applications, and we qualify, and we've had quite a bit of success with some of them, yes.
Okay.
So I think the answer is that there's no project-based vouchers.
No project-based vouchers.
They accept
sorry.
Section
Yeah,
8 vouchers,
yeah.
but there's not project-based vouchers.
There's no project-based vouchers,
Yeah.
correct.
Okay.
So, Mr. Chair Cervantes,
Yes,
this is a question
Justice
for staff. Thank you very much to the developers. Appreciate your
Thank you both
feedback.
very much.
Just 3 areas, I don't know, Stephen or Stephanie. The correction should be made on the project description that it's not 1 story, because that's misleading. To answer the question around 370,000 per unit or less, that's an amazing number. That's fantastic. That's wonderful. It is a product type, I think. It's 222,000 construction costs per unit. So I think that's really kind of critical. The other thing I want to point out for the board, and it's not so much a question, but it really is something that I think speaks to what Director Prince had previously said, but in the capital stack, there is no local subsidy in the capital stack, that this is all tax credits and CalHFA and MIP, right? And so to the extent that it is saving, it doesn't have any HCD money, it doesn't have any other kind of money. So I assume that, I'm not sure if prevailing wages are triggered. I know there's probably no project labor agreement associated with the construction of this. So, in terms of the capital stack, and we'll see this in the next project as well, there's no local subsidy. And yet, so that's not a judgment, it just is the facts, right? So I think that when we look at our MIP program, we're stepping in as the only public subsidy source. And 1.6 million for a 190 unit project is not a big number. And I think what you're asking for is for the approval of the $30 million permanent loan, not necessarily the approval of the 1.6.
That's absolutely correct.
Okay, great. So the last point I would just make is that I guess to the extent that we have the exception of the density bonus being senior to our loan, it would be important to, somewhere in the staff report, and staff knows this, I'm always harping on staff reports, but if we could put in there what the density bonus requirements are,
I
and
believe it's in there.
is it, okay, what page would that be?
I don't know, I thought I just looked at it
Just
this
because I
morning.
need to, so part of it is, it's okay to subordinate.
Page 11 of the staff
Page
report.
11, okay. To subordinate to
Section
that
6A.
if we know what the requirements are. So that, thank you for clarifying that.
I think, yeah, it's 10% of the
6A.
units at 60% AMI, which resulted in a 20% density bonus and some design
Okay.
waivers.
I'm not seeing the density bonus requirements, I'm seeing our requirements, but, okay, I will.
On page 11, it's number 3. The city of Palmdale is requiring a density bonus agreement.
Oh, number 3 in the notes, okay.
Yeah.
Okay, great. So I think that exception would be appropriate. I just wanted to call that out. Thank you very much for that. But, you know, great number. It's unrealistic to build this any other place other than where you have 18 acres, but.
Thank you, Director
that's
Sotelo. I think we're gonna lose you for a minute, but I want to see if there are any public comments, and then I'll ask for a motion to approve. Melissa?
Are there any members of the audience that are interested in making a comment at this time? No hands are raised.
Great, thank you. I think unless there's any other board questions or comments, I'll entertain a motion to approve Resolution 25-03 to approve the final loan commitment for the Masons Village project.
Motion to approve.
Director White? I'm sorry? Is that? Director Henning, thank you. Motion made and second to approve Resolution 2503. Melissa, can you please call the roll?
Chair Cervantes?
Yes.
Ms. Kurgan?
Yes.
Mr. Henning? Mr. Prince? Mr. Russell? Mr. Fiegels?
Yes.
Ms. Sotelo?
Yes.
Mr. Olmsted?
Yes.
Dr. White?
Yes.
Mr. Williams?
Yes.
Resolution 25-03 is approved.
Great, thank you very much. So with that, you're still up here, so we've got.
Yes. Still here.
Action items,
Still
you're
here.
still here, still standing. Item number 6, the final loan commitment for North City, Resolution 2504 will follow.
And Mr. Chair, I will be recusing myself from this item.
Thank you, Director Russell. Stephanie, please.
Great,
Please
thank
go on.
you. We are bringing another transaction for your approval because the permanent loan amount is over $15 million. In this case, it will be $39.15 million. This is a 224-unit family development located in San Marcos, San Diego County. This project will be a single 4-story building, elevator serviced. So these costs are a little bit different than the earlier project. And the AMI served in this project will be between 30% and 70% AMI. This project includes a MIP loan of $4 million and includes an exception to our policy for a density bonus agreement. That, I hope you were able to get what you needed from the executive summary or the whole project summary report in your package, but I'm happy to answer any questions. And we do, in fact, have the developer here. You've already heard from him today. But I told them they wouldn't have to talk to you guys, so. Anyway, I know.
We'll put it through its paces. Are there any questions or comments from the board on this particular project?
I have a question regarding this capital stack on this, Chair Cervantes.
Yes, please.
There is a great deal of taxable debt on this, no local subsidy as well. And I just, from an underwriting standpoint, I just want a little bit more flavor from staff in terms of the underwriting and the comfort level that we felt with so much taxable debt from city. Our recycled loan is in here. We have another taxable loan in here. So if you can, there's no public subsidy. And then Carmel Enterprises LLC, if you can tell us a little bit more about that. Again, to the extent that we're just trying to understand capital stacks without needing huge public subsidies.
Sure. I think the sources that you noted are for the construction period, I think, the recycled bonds and the
Correct,
taxable
yeah,
debt. So there is a
The
construction.
Carmel Enterprises is still in the permanent stack.
Sorry, Enterprise?
Carmel
Carmel
Enterprise?
Oh, I believe that's the deferred developer fee.
Oh, okay.
So just looking here for the construction lender. Oh, it's a developer loan? Okay, I'm sorry. So in a project like this, the construction loan is going to be a lot larger than the permanent loan, as you know, and we facilitate issuing bonds using taxable or recycled bonds if we're able to. And that's why those pieces are in this deal. I don't know a lot about the developer loan. Steve, do you want to just say a couple things about it?
I'm just trying to understand, Director Sotelo. So when you're asking the question, are you asking why approve something like this versus public subsidy? I just want to understand the framing.
I'm just trying to understand, I'm just trying to bring more color to the conversation so that as a board I can understand how a project of this size is happening without local public subsidy or state public subsidy. So if the 12.2 from Carmel Enterprises is different from the deferred developer fee of 1.4 million, just kind of understanding that dynamic.
Right. Well, I'm afraid, Rob, I'm going to ask you to come up here if you're still here. You know, these are deals that are very hard to put together, as you know, without additional public subsidies. So the developers are quite creative. And so I'm going to let this developer explain how he has structured this deal.
Okay, but before he does that, just from a staff level, when it comes to the conversations around how we as the MIP program would get paid back with a capital stack that has the developer participating in contributing, but then recovering their own dollars, I guess
In
it's
this
subordinate
particular
to our loan.
case, we are receiving 50% of residual receipts per our program requirements. So we feel comfortable with how the project NOI is going to look over the next 15 years. We feel comfortable with how our position in that residual receipts flow is going to remain. And we're allowed to give them the 50% of that cash flow. So
Okay.
I'm not exactly sure if that addresses the question, but do you want to hear a little bit? I guess the question is really about how do you put these deals together?
Welcome
I guess-
back.
Go ahead. Hey, Rob Morgan with Trestle. We're serving as a development consultant on this project. So I'll do my best to answer your questions, but please, if I don't quite get to the heart of it, feel free. I think there was first a question about the taxable debt, and so I think Stephanie and Steve shared that well, which is just about timing of funds. And so during construction, there's more debt that then gets repaid. The main difference there is the timing of tax credit equity. So the tax credit equity investor doesn't contribute the majority of their equity until perm conversion. So there's just a sort of timing of sources and uses of funds. So essentially that tax credit equity will repay the taxable construction debt that's there. So does that make sense?
Yeah, no, I understand that concept. I think my question was around the burden that puts on the project from an interest carry perspective compared to a public subsidy that wouldn't have any interest carry, right? And that's fine. I just, again, for our edification, if you have $20 million of taxable debt during construction, you have to create an interest reserve for that at 6 or 7%, whatever that taxable rate is, versus a $20 million HCD loan or a public subsidy loan, which has no interest carry during that period of time. So it just
absolutely
impacts
correct.
construction cost.
Yes.
Right? So I understand the concept of what happens.
Yep.
I just
Yep.
want to,
Yeah, you're
Point
spot
that
on
out.
there. It does add costs by doing that in interest cost.
right. And then on the Carmel Enterprise LLC, can you tell us about that loan?
Yeah, Carmel Enterprise LLC is essentially, they're a master developer in this urban plan. And so they had an obligation for affordable housing in the community that they had already. And so what they had a desire to drive deeper subsidy because of the ownership desire to really, the location was very walkable right next to the Sprinter station, right across from Cal State University San Marcos. So there was a desire to bring deeper affordability, and utilizing some of that program, some of this program, they're able to drive and really make a very interesting large family project.
Okay, so this is like a linkage fee that instead of being paid into a fund is being paid directly into the project to build it out.
Yeah, there's an obligation in the master plan to
okay,
deliver a
so-
certain amount of affordable housing.
Okay, so it's on a deferred developer fee.
No, I wasn't
Okay, great.
Yeah,
Okay,
correct.
thank
It's
you
not
for
a deferred
clarifying that. Yeah, that's the $12 million that would be considered a public subsidy,
Yeah.
basically. Okay, thank you very much.
Thank you. So, Rob, don't leave yet, please.
Okay.
I have a question, but I want to see if any other questions from members of the board? The one thing that caught my eye was, so I was reading the descriptions, there'll be 16 SRO/studio units. And of course, when I think of single room occupancy, from working on a nonprofit in the Tenderloin, that's kind of where my mind goes. This sounds very different, but it was interesting. This is like, could you talk through the project just a bit? Because it sounds like it's right by I guess it's Cal State San Marcos then?
Yes.
And, you know, this is all part of a whole. So you're doing student housing here as well as part of all this. Could you just talk through a little bit what the project is? I'd be kind of curious.
Yeah, I mean, the master plan there, it's part of the university district-specific plan that the city of San Marcos has, and there's a pretty dynamic mixture of student housing, an educational building, there's multiple market rate, even a 12-story tower that's being built with walkable ground floor retail. There's also some for-sale housing that's happening on the western edge of the master plan. And so in terms of the studio SRO, it's just a traditional studio unit. They're about 450 square feet, and it was partly a design, dealing with stairwells and other things that fit well with the plan, and the desire of the developer was to have a broad mix of unit types, including some of those that are smaller size like studios, but it's a pretty small, less than 10% of the project, so.
Okay, that's helpful.
Sure.
Appreciate that. Thank you very much. Any last questions? I don't see any. Mr. Morgan, thank you so much.
Thank you.
Sure. Melissa, could you please see if there's any public comment or questions?
Are there any members of the audience interested in making a comment at this time? I see no hands raised.
Okay. Then I would like to see if there's someone would make a motion to approve Resolution 25-04 to approve a final commitment for this project.
Motion to approve.
Thank you, Mr. Henning. Is there a
I'll second.
Thank you, Director Sotelo. Motion made and second to approve Resolution 2504. Melissa, can you please call the roll?
Chair Cervantes,
Yes.
Ms. Kurgan, Mr. Henning,
Aye.
Mr. Prince, Mr. Fiegels,
Yes.
Ms. Sotelo,
Yes.
Mr. Olmsted,
Yes.
Dr. White,
Yes.
Mr. Williams.
Yes.
The Resolution 25-04 is approved.
Great. Thank you.
Thank you.
Thank you so much. We appreciate it. Okay. Okay, so we're going to move to agenda item 7, the expansion of the National Mortgage Settlement Fund. And our interim executive director will walk us through this. Thank you, Rebecca.
She could have done it from there.
Good afternoon. Rebecca Franklin, Chief Deputy Director, CalHFA. I am here today to present to the board an action item. It's a resolution 25-05. It was emailed to you last night. We apologize for the timing of getting the documents, but as you can tell, this effort has kind of been evolving as things evolve. And so we're trying to get to an ability we're requesting through the board to meet the moment and be able to assist the people actually assist people across the state now from natural disasters, since 2023 is actually the date that we're looking for. And yeah, I guess I just do apologize for the timeliness of these materials, but bear with us. I think we'll be able to kind of answer all the questions. I also, in my opening statement, said that, one of my favorite quotes is, "The path has been laid by the giants that came before you." And so I do want to recognize the expertise of this board in this disaster recovery and relief space. Mr. Fiegels also was a predecessor to mortgage relief efforts actually distributed by CalHFA. So going to the first slide, so you have a copy of the resolution. It outlines kind of more details of what we're asking the board to approve today. But essentially, as I addressed in my opening comments, that the governor has requested the CalHFA to review and hopefully approve a proposal of the remaining national mortgage settlement funds. So we have two tranches of relief or support that we would like to deliver with the remaining of these funds. First is $25 million to extend and expand the existing NMS housing counseling program. Ms. Tariainen is very well versed in that program, and we'll kind of get into more details of what that expansion looks like. And then the second tranche of that funding, which is $100 million, it would be over $100 million, we'll be able to disperse to homeowners whose homes were damaged or destroyed by natural disasters since 2023 in the state. So kind of high level, what we're asking today is those big tranches, and that will be the rest of the NMS funds we're requesting to kind of allocate this morning. So going to the next slide, Ms. Tariainen can give you a high level of what these funds specifically will be doing to support the homeowners, or actually the residents of the LA fires, et cetera.
Good afternoon, members. Can you hear me all right? This is going to be a problem because my glasses make it so that you're all blurry, but without them, I have no chance of reading anything. Thank you for your time and attention today. So I'm before you to ask for basically two components of the housing counseling program, which this board authorized beginning in 2020. That core HUD housing counseling program serves all residents of California with free housing counseling. And the topics can be pre-purchase counseling, eviction prevention, foreclosure prevention, and financial literacy. The program also helps those who are experiencing homelessness or who are at risk of homelessness. Within that core program that we've had running for these last 4 years, every single participant, every household that participates gets a budget put together for them by the housing counselor. The program has been very successful, I believe, based on the most recent numbers that I've seen, which are as of June of last year, we've helped roughly 80,000 families throughout the state. I'm before you today because the program is expiring this calendar year, so we'd like to extend that and fund it through December of 2025. My second ask for you today is specific to disaster victims. We would like to augment the existing program with counseling just for those whose housing situation has been destabilized, which can either be the house is uninhabitable, the home no longer exists, or the person is struggling to afford his or her home because the place within which he or she worked no longer exists as a result of the fires. This second augmented type of counseling will not include a complete budget. It will assist folks in filing insurance claims, understanding what's available to them through the SBA, FEMA, and any other local resources. It will help them to understand that price gouging is illegal and what opportunities they have to address any price gouging that they've experienced. Some folks are having very basic problems, such as they can't get to their prescription medications, or they don't have a place to shelter a beloved pet because their home has been destroyed. The housing counselors would do a truncated and expedited counseling session with disaster victims to help them get to the resources that they need to stabilize their current situation. And those are the asks that I have for the Board of Directors today. Thank you for your time and attention.
Tables on wheels, okay. So the second part of the ask is, oh, good job. Is for the mortgage assistance portion of the program. The NMS funds originally allocated to the state had a very strict allowable uses, and one of them was for mortgage assistance. So when the LA disaster did happen, we were very much quick to put our hand up and say, we have a pot of money that's already allocated for this kind of use. So we are very excited to be working with the administration to see where the best use of these funds would go. But it is very rigid in that we did need to use these funds for mortgage counseling or mortgage assistance. So wanted to highlight that for the board. So at a high level, really what we've been doing for the past 6 weeks or a month has been working with a lot of our business partners and stakeholders within the administration and the state, closely working with BCSH, with HCD and their recovery teams, as well as CalOES, to find out where could we be most useful administering these funds with the mindset that we knew we needed to do mortgage assistance. So what we've come up, this is a high-level proposal of kind of what this would shape out to be, is providing 3, possibly 6 months, depending on the fund availability to homeowners, so mortgage payments. So the idea is that we would then make mortgage payments for an affected homeowner for 3 months. That allows them to use the funds that they would have allocated towards paying that mortgage payment for other recovery efforts. Internally, this is probably not the name we'll end up using, but we've been calling this Project Hope because we want to give these people hope and see a future of them rebuilding and establishing their residence again in these areas. Really looking at the communities of Altadena, where there's a lot of generational wealth in that area. And so we've been trying to design a program around kind of the needs, specific needs of these communities. Many of you have been on the journey with me personally on the mortgage relief program that was ARPA funded. That was a COVID relief program. And in our last CalHRC board meeting, Director Sotelo, who kindly also sits on that board to support us, said, hey, this really worked out well. There's a lot of great learnings. Do you think we could be doing this in this space? And exactly what we are trying to do. So we're asking the board, while you're up in this resolution, we are asking the board to approve the executive director of CalHFA to be given the authority to kind of design, implement, and execute this program in its entirety. I want to give the board assurance, we're not going to reinvent the wheel that we've already kind of established and kind of iterated and made a very good working program, and the mortgage relief program. We're going to take many of the elements that we had in the former program and apply that here. Obviously, this is a different source of relief that we're providing, so we want to make sure that we're, helping those. But this would be going to homeowners where they lost or their primary residence was destroyed, the homeowners who don't have a secondary home to go to or there. We would want to prioritize low to moderate income households for this program. And so while we're asking, if you go to the next slide, we're asking for a lot to be given in this resolution today to the board. We want to commit that we will be updating the board frequently about the program, about its design. There is a typo in that March bucket. We're actually asking the board to give the executive director the authority to do so today in the resolution. So in March, we would be willing to come back and update the board on the progress of the program design. What we're trying to do is be very, very fast, very nimble. We just sunsetted the mortgage relief program. We have an opportunity to go back to those same technology systems, those same applications, and rather from building from the ground up, we're able to modify those to fit this need. And so we want to make sure that we're able to help these homeowners timely, and timely is really, we are gearing towards being able to start, we're saying like a June 1st launch. We really are trying to get into a month of May launch. And I've been counseled many times to not say my aggressive timelines, but for this board, I'm comfortable to say our vendor that we would like to re-engage, the same vendor we used for the mortgage relief program, and being able to take those systems and just modify rather than rebuild, we're very confident that we're able to kind of hit the market within that 2.5 month build zone. And kind of that's all the material we have. Again, sorry for the lack of timeliness on the materials, but happy to answer any questions.
Thank you both very much. Do other questions from members of the board or comments on this item? Director Russell?
Yeah, I just want to say, first of all, this feels like the right thing to do. There's no question about that. I think the one question we should ask is, so what are we not doing by doing this?
We're not doing anything. That's the beauty and the frustration sometimes of the NMS funds, is that when the legislation was established, this fund was established, there was only 2 allowable uses, for mortgage assistance and for housing counseling. So we're not doing anything. We just happen to have an allocation of funds that we hadn't distributed. We were working on a program way back pre-COVID on a mortgage assistance program using these funds, but when the pandemic happened and President Biden signed the American Rescue Plan Act, and we got over $1 billion in funding for mortgage relief, we had put this set of funds to the side and focused our energies on deploying the mortgage relief funds from the COVID relief package.
So essentially, we're just focusing the resource we had, which might have been statewide. We're focusing it on the disaster-struck areas. Is that fair to say?
Yeah, I'm sorry. I also wanted to give Director Kurgan the floor. Since this is a proposal coming from the administration, I wanted to make sure if you had any comments.
That's very nice. I think that in the governor's request, he mentioned also not just focusing on the most recent fires in 2025, but going back to disasters back to 2023. So there will be a larger geographic spread. We have the Governor's Office of Emergency Services, or CalOES, has a lot of responsive data because they're kind of like the state equivalent to FEMA. So they have information about past disasters and then have an evolving landscape of data related to these disasters. But there are some things that we already know, and I think that the proposal is responsive to some of the things that we're hearing already. A lot of uncertainty, which happens after any disaster, but Los Angeles has lost more than 10,000 structures, with the majority of them not being businesses, but being residences. The degree to which they're primary residences, we don't yet know. That is some of the evolving data. And there are things that the housing counseling component can really help with in terms of making sure that survivors are supported regardless of their housing status, but to make sure that they have a plan and that they are informed about some of the federal thresholds and the very quick turn-off of assistance that can happen. And so navigating through a complex FEMA process is something that the HUD-trained housing counselors are already well-equipped to do. This is part of disaster response broadly. I think many of us have seen the articles about HUD today, so I think our ability to make sure that those intermediaries that CalHFA has been working with for years are really activated right now to maintain steadiness provides great support. And while a lot of that, I could imagine, could be focused in LA, there are still survivors who are dealing with the impacts from those disasters in 2023, 2024, because the tail of recovery is so long. So that part feels really responsive to make sure that we don't have survivors becoming homeless permanently. That path to prevention is something that's really critical. And then on the mortgage relief component, mortgage assistance component, this feels helpful and complementary to what the governor's already done with the Department of Financial Protection and Innovation, the DFPI, which is also part of the state family, and the BCSH team, and a team that CalHFA has worked with in the COVID mortgage assistance to make sure that the lenders are well informed about these opportunities and are working closely with CalHFA in implementing them. That part's important, but it also builds on an earlier executive order where the governor's been working to achieve forbearance that just extends, not with a balloon payment. So it's complementary as part of a suite of tools to make sure that disasters have options right now, with none of them really being a panacea. And with the amount of funds that we have, this is not a panacea for all housing needs, but to make sure that, again, that we're not pushing people who have lost everything into the brink of long-term homelessness. It feels like a complementary strategy. So I think last, I'd just say CalHFA's relationship building that they've done and demonstrated not only in Dream for All, but in the mortgage assistance program shows that they're equipped to work with community-based organizations that are really going to be feeling the forefront of this and working with survivors most directly. And so I think that's another, I think it's very special that the governor asked CalHFA to do this for this purpose and to take a statewide approach, even though what everyone feels right now is the urgency of LA. I realize that was a lot, but Rebecca, thank you for the space.
Thank
If
you.
if I may, just continue on, I just want to say that whereas, yes, it feels right, yes, I will be supporting this, I think that the trust that you have built through the programs, as Secretary Kurgan has suggested, that you're coming to us with a general concept, I have complete faith that you will implement it in a professional, responsible, fiscally sound way. So I will definitely be supporting the action today, and thank you.
Thank you, Director Russell. Other comments?
I just have
Yes,
one.
Dr. Williams.
I understand that it's gone all the way back to 2023.
Yes.
Which sounds great, but if you lost your house in 2023 and here we are in 2025, you've already gone through much of the anguish and the challenges. How can this really be practical for somebody who lost their house in 2023?
Working with CalOES, we don't feel that adding the extended year of the natural disaster, we felt like because of the funds, we want to make sure that anyone that was affected by a natural disaster has the opportunity to receive assistance. So we didn't feel that it was the most proper use of funds just to say, those affected by this most recent disaster. Unfortunately, there's been many across, the 2023 mark, while I do think there are some homeowners that are still in need of support in the rebuilding process of their homes. I know the governor's press release for the request to this board cited the Franklin fire and a different fire, and one of them was up in like Butte County. But I would say working with the HCD team and understanding the different recovery efforts. Also, we also have our director of homeownership has like side expertise on these areas. So, the Camp Fire, people were, not starting to rebuild. It was 2 years before that. So, while 2023 does seem far out, it actually is not that far out if you want it, and as far as timeline, when you think about there are people that are still being affected by those and could use support. And we wanted to make sure that anyone that needs that meets this criteria, does have the ability to get that hope again.
All right, thank you.
Thank you, Director Williams. Any other comments?
I would just be responsive to that. There could be homes were not completely destroyed but damaged, where people are still living in them, paying their mortgage, but still struggling to rebuild. So I think it's about the opportunity. So we need to think about, many of those other disasters were not fire related, some were flood. So there are various levels of damage and destruction that people face. And so many of them there are probably a subset of folks, I know there are, that are still living in their homes that probably could be taking advantage of this post-2023.
Thank you, Director Olmsted. Director Henning?
First, I should say the treasurer is in complete alignment with the governor when it comes to wanting to make sure that we're doing everything we can from the state side to provide assistance. I do have a couple of concerns. One of them, I was very heartened to hear from the Secretary's point of view that this assistance will go and be allowed to use in other disasters other than just LA. There's areas of our state that are still struggling. I'd like this resolution to reflect that, because right now it's very heavy on Southern California. It mentions the LA fires, but it doesn't mention any other disasters. So as we're considering this as a resolution that we're about to approve, if the council pleases, if we could add after in Part 2, Section A, the January 2025 LA area wildfires, if we could add and other nationally declared disasters. Is that fair?
Is it FEMA?
I don't want to wordsmith while we're
Presidentially declared?
Presidentially declared.
Presidentially declared?
and just to leave it open so that we're covering Sonoma, we're covering Paradise, we're covering other areas of our state that are also have been affected.
Since 2023.
There you go. Yeah. And then the other thing Madam Council, you know, this is a very serious issue. Receiving documents at 5 o'clock the night before we're supposed to vote on these issues, I know is not the preferred path. But I'm concerned that it brings up Bagley-Keene and other issues on timing and making sure that this has the public light on it. I do know that we have a section that is a very broad section, and I just want to make sure that we're in the clear in voting on this document.
Yes, thank you for your question, Mr. Henning. It's well taken. What Bagley-Keene says essentially is that so long as the materials are published to the public simultaneously with being published to the Board of Directors, we're not in violation of Bagley-Keene. As long as members of the public could see this contemporaneously with the timing of the board members, we're okay. Thank you for asking. It's a good question.
Also, if it make, Director Henning, the item was agendized, so the use of these funds was agendized. That agenda was published a week in advance to this meeting, 10 days in advance, sorry. So yes, I do, and I do apologize. We are trying to move as nimbly and quickly, but this shall not be the norm, obviously, for this board, but we do respect those things.
I appreciate that.
All right, Director Sotelo?
I would just like to reiterate Ms. Franklin's summary of our board meeting that we had about a week ago about the funds, because we have such a great infrastructure that we've already built for mortgage assistance, and from, you know, the recovery, the previous COVID recovery funds, that I really want to emphasize and have the board support the idea that these funds are made specifically for, you know, a recovery effort, right? They're made for mortgage assistance and to help. So, you know, we're not deviating from the intent of the original issuance of these funds. So we have the infrastructure to do it. We have the relationships to do it. And, you know, it's just such a natural extension of the work. So I want to compliment the CalHFA staff for doing that. Also, I just want to clarify that under the HUD certified counseling support, that is not income driven, right? That regardless of your income, you can avail yourself to the counseling.
That is correct.
Okay, and then the actual mortgage assistance is income restricted, so that moderate income is the highest that you can be, and that will be determined through verification.
Correct. The intention of this program and the sentiment is to, I think Secretary Kurgan also said, we like the word toggle, so we like to be direct and pointed in the assistance that we're going to launch. So yeah, we're really gonna prioritize the low to moderate income households. Funding dependent, we can, just like in the mortgage relief program, we started with one
Right, and then expanded.
definition, yeah. So as we come back and inform you guys of the kind of things, look for toggles. That's kind of our favorite program design element. So, but I don't see us not, I see us prioritizing them for sure.
Right. Okay, I just, you know, all the work that the governor has done to, you know, really be responsive to this disaster and other disasters is so impressive and very creative. And I just want to make sure that, you know, we continue to support that effort, because it is great leadership that he's shown. And then to the extent that forbearance is being mandated, really, and mortgage companies are forbearing their mortgage payments, this is on top of that, right? This is not substituting that. So that whatever concessions the governor has gotten from mortgage companies to forbear the debt of victims, this is going to augment that. It's not going to substitute that.
Yeah, I think the forbearance is a 90-day forbearance. So actually, if you're looking at the time, and this is why we're trying to move as fast as we can, the program will actually launch after the 90-day mark has occurred. So homeowners there wouldn't be if in the term sheet, we would have the same. If you've received assistance in FEMA assistance or something like that, you wouldn't be precluded from this program for accepting additional resources.
Right, so you're expanding the ability to do that. That's fantastic.
It's in complement, and we're in concert. We were just talking with DFPI yesterday about understanding exactly the conversations they've been having with financial institutions and ensuring that our conversation when we approach them with our collaboration agreement is a continuance of that conversation rather than feeling like another entity is coming at them in a different space.
Yeah, I mean, and we're making both the homeowner whole by alleviating the stress of having to make a mortgage payment on a vacant, demolished site, but we are also helping the mortgage companies and them continue to have business in the state of California because, they're not having to go through a foreclosure process or anything else. So we're also alleviating their issue. And then in context of that, we're not expecting any repayment or recycling of these funds.
No, would be a grant of funds. This would not be any sort of lien or expecting
No lien
repayment.
or any, okay, great. Thank you very much. I appreciate the time.
Thank you, Director Sotelo. Any other comments, questions from the board?
Just one real quick comment. In the same section of the resolution where we're expanding the language beyond the 2025 LA area fires, if you're intending 3 to 6 months of mortgage payments, the resolution currently calls 3 to 5 months.
We can make that change.
Yeah, just wanted you to catch that. Yes.
Good catch. Thank you.
I'd just offer, is it an up to number? Because you're still exploring kind of demand on the program, parameters of the evolving data. And so point well taken, like to be consistent, but it sounds like you're still in a space where you're evaluating how far you can take the assistance.
Yeah, we're trying to prioritize reaching a max amount of homeowners. So, I mean, as I sit here today, unless Mr. Olmstead's team helps me get a different number, we'll probably launch with a 3-month up to 25,000 cap. We're looking at also not only with low to moderate income households, we're looking at using the home at origination was below the conforming loan limit for LA County for 2024, which is about 1.4 million. So we feel like, creating criteria, we haven't locked in all criteria. We don't want to use conforming loan limit the year of origination. I can tell you that right now, speaking from the ARPA program. So we will be looking at that, but we probably would go to market with the 3 months of assistance. If there was other funds allocated, if we, don't reuse all of the funds with the 3 months, we can look to expanding the number of months we could cover in the prepayment space, probably up to 6 months, though.
Okay. Any other comments, questions? I'd like to see if there's any public comment on this item. Alicia, if you could check.
Do we have any members of the audience interested in making a comment at this time? No, we do not.
Great, thank you. And just my observations here, I really appreciate the work of staff, especially the working with our colleagues at BCSH, with OES, HCD, within the administration, trying to sort of like pull on our oar in this effort to try to like address some of the issues that the residents of California and, the following through the work of the governor to try to create mortgage forbearance and create a framework for relief of, this sort of catastrophe. And in that spirit, the more I see the original program was dealing with a catastrophe, it was COVID. This is another one. So reprogramming the funds with a platform you've already created and moving quickly, to me, are great hallmarks here, great work by staff. I'm perfectly content to push ideally you'd say we'd have materials ahead of time so we consider the March meeting. That loses a month. My feeling is just to push ahead. And if the program can be delivered before June, that's terrific. And I really respect being careful about overpromising and under-delivering, but I know staff will work towards that end. So what I'd like to do before calling for someone to make the motion is to reread that language that's been modified, because we've had a couple of changes there. I think it'd be helpful. And then with that out on the table, maybe ask for a motion. So,
and Mr. Chair, I completely agree. I very much appreciate that. The one other little correction is if we're going to be making that change to the actual language of the document, the whereas is number 3 or 4, whichever whereas you want, should also be slightly adjusted to reflect that we're talking about not just the Southern California wildfires and fires.
Okay.
Because now we're talking about flooding and that type of stuff.
Okay,
And I think that's the desire of the administration's proposal.
okay, thank you. Good comment.
So, Chair Cervantes, would it be useful if I recited to the board members the proposed changes as I understand them?
Yes,
Okay,
that would be, thank you.
sure. So if we look at the first page, whereas number 3, even though it's not numbered, it currently says areas of Southern California. I would insert the words areas of Southern California and other regions of the state that have been ravaged by wildfires. I would just say and other disasters.
Yep, agree. Other disasters declared since January 1st, 2023.
Federally declared natural disasters.
Presidentially declared.
Presidentially
disasters.
declared natural
I
disasters.
don't know if you'd want natural.
Yeah, not natural, just presidentially declared disasters.
Presidentially declared disasters. Say that 3 times.
Nope, not
Okay.
The date is important, June 2023, right? June 1st, 2023. It's January.
Okay, so shall I repeat that again to make sure that I've captured it properly?
Thank you.
Sure. So what I have now is whereas areas of Southern California and other regions of the state that have been ravaged by wildfires and other presidentially declared disasters since January 1, 2023, which have resulted in the loss of thousands of homes and businesses. Does that sound acceptable? Yes?
Sounds good.
Okay,
Thank you.
sure.
And then on that part 2,
Yes, so if we flip to what is page 2, part 2, mortgage assistance, sub A. I believe Ms. Kerrigan's suggestion was that the language would read, the board directs the use of $112 million to fund a program that would provide 3 and up to 6 months of mortgage payments. That was, I think, Mr. Fiegel's and Ms. Kerrigan's suggestion. Is that correct?
Works for me too.
Chair Cervantes?
yes.
Yes, okay. And then proceeding further into that sub A, I believe we have, this program would need 4 to 6 months to ramp up and details. No, I don't understand what I have there.
The mortgage payments of, to victims of.
Okay, thank you. Can't read my own writing. To victims of January 2025, LA wildfires and other presidentially declared disasters since 2023.
January 1st, 2023, please.
Yes. Okay,
And the January 1st, 2023 date maps in the whereas as well, right?
that's correct. They would
Great.
then be aligned.
Thank you.
Okay?
Okay.
So those were the only changes that I captured, Chair. Were there any additional?
I don't think, Director Russell?
For consistency's sake, excuse me, the fourth, 1, 2, 3, fourth whereas displaced victims of these disasters, it says the wildfires right now, should be these disasters.
Yeah, it's a good catch.
Displaced victims of, I'm striking the wildfires and I'm inserting these disasters.
That's good.
Okay?
Thank you.
You're welcome. Thank you.
So it feels like we're sort of like kind of working on the airplane while we're flying it, but that's kind of the
Okay,
nature
that's what
of
you
a
do.
situation like this. And
Welcome to the last month of our lives.
yes, that's right. And again, I think to me, it highlights that all the effort that's been going on all different parts of our state government to sort of address this issue. So this is our part in it. So with that, I'd like,
Mr. Chair, and I
Yes.
apologize, but we're still in the air here a little bit.
Okay.
But it refers in section B, or part 2, section B and C to agency. And I think at one point, I've seen a lot of talk about the CalHFA board. And there you do have one instance where it says, at least one instance where it says agency, but want to make sure that agency is clarified. And I'm sure there's some way of putting it in parens or some deal like that, whereas in the future refer to agency, it's CalHFA agency.
Oh, of the agency.
or just put CalHFA where it says agency, however you want to.
So if we look at, I just want to make sure that I'm following you, Mr. Henning. If we looked at the end of the whereases, it says, now therefore be it resolved by the Board of Directors of the California Housing Finance Agency. Would you like me to insert a parens that say hereafter agency? So that it's clear that it's a reference back?
However you want to do that, or where it says agency, put CalHFA, whatever is easiest and most direct counseling.
I think the less edits would be to put the parens in that introductory sentence. Okay. We just want to make sure it meets.
Yeah, and I would just, again, if we're doing this on the fly, I want
No.
to make sure that we got clarity.
We support the engagement of the board at this level with this effort.
So never let it not be said that this is a working board.
Yes.
So, thank you.
Thank you, guys.
Okay.
I was going to say.
I'm looking to see if there's a motion to approve Resolution 25-05 as amended. I'll make that motion. Thank you, Director Prince, and thank you, Director Henning. Motion made and seconded to approve Resolution 25-05 as amended. Melissa, can you please call the roll?
Chair Cervantes,
Yes.
Ms. Kurgan,
Yes.
Mr. Henning,
Yes.
Mr. Prince,
Yes.
Mr. Russell,
Aye.
Mr. Fiegels,
Yes.
Ms. Sotelo,
Yes.
Mr. Olmsted,
Yes.
Dr. White,
Yes.
Mr. Williams.
Yes.
Resolution 25-05 is approved as amended.
Great, thank you all. And I'd like just to thank staff and everyone else around this table who's been sort of involved in this effort. So work well done, and we'll look forward to getting an update. Thank you.
Thank you.
Okay, we're moving to item number 8, which is an update on the 24-25 second quarter strategic plan and operating budget. So Erwin Tam will join us, and
Still me.
okay, thank you.
And we've been doing our meetings much shorter lately, and I've double booked myself. Is there going to be a vote that you need me here for? Can I get on the road? And I totally apologize.
This is purely informational, and the last agendized item, the rest are informational reports.
Right.
But as,
It's very important, but I definitely talked way too much earlier, so it's my fault. But I am not leaving because of.
as always, we encourage any engagement from the board if you have additional questions after the board meeting.
So, thanks for giving us the heads up, and we'll miss your voice on these matters, but look forward to seeing you in March. Take care. Okay.
Good afternoon once again. Rebecca Franklin, Chief Deputy Director. I'm here joined with Ms. Madsen and Mr. Tam to complete our second quarter strategic plan update to the board. As you guys know, with the strategic plan, we developed a reporting process and committed to coming to the board once a quarter after the quarter end to give an update. I do want to remind the board, we do exception reporting with these items. So if everything was green and good, we would put it as an informational item, which the board could then comment on in that period. But we have some items to talk about today, and so we're here to present that kind of higher level update. And then Mr. Tam's also here to give more of the financial operational update to the board. I'm going to start us off with the strategic measure dashboard. As you know, goal 1 is our lending impact. In the last quarterly update, we did have a little bit of an extended dialogue about the goal setting for this particular set of goals and whether with the turnover in leadership and kind of just, CalHFA has kind of gone through a little bit of a transformational effort, I guess, inside out, whether we were comfortable with these goals, and we committed to doing some analysis on the back end and coming to the board if we felt like, these goals maybe needed to be realigned or reset. I'm happy to say that we aren't asking for that today. But with transparency in mind and understanding what happened last fiscal year with some of our multifamily projects, we wanted to mark the unit goal yellow. So yellow means it's at risk of not being met. So what the multifamily pipeline is not a linear pipeline where it's just, every month we're contributing. The deals close in batches. Everyone I know is aware of that, but just to remind the board. So while we look at our pipeline and we say this pipeline's very healthy, and if everything in the pipeline goes through as planned, we will make that goal. And so we want to make sure, that's why we're coming to the board, not asking to change the goal, because we do have the pipeline to support that number. But as we all know, things happen, projects fall out, they close late. That's what happened last year for the most part. We had 3 projects that closed the week after the fiscal year end. But we want to make sure that we are providing you guys assurance that when we see trends and when we see things at risk, we're going to be transparent about that. So that's really why that unit count, if you go to the next page, there's the exception report on it, on why we think that this may be goal. Because we're saying is, come the end of the fiscal year, if things have slipped, if we have conduit deals drop, the market changes, we're in a very different climate sometimes now coming from the federal government and what's going on there. We want to make sure that we're just being very transparent that there is a chance we may not make that unit goal. If we go on to the next goals, those are green, so I'm not really going to visit them. We're in a really healthy place from a financial stability. Our ratios are good. Mr. Tam keeps us all in line in our spending, so, we can all thank him for that. In goal 3, same, we've actually done very well in this goal. Our new director of multifamilies really taking, not only is she executing MIP and maybe designing a few programs on the side, but she's really taken a sincere effort to go into the development community, understand their needs, make strategic alliances and relationships with them, and really is a listening ear. So in this trusted advisor space, we want to be a seat at the table. We want to be in the conversations, and I think that we're doing a really good job at that. The last goal is our operational goal, and from the strategic measure, we are doing also very well in this space. We're trying to be, we need to make sure we have key staff in the right place, and Tom Collins on the right bus in the right seat, but also that we're, being efficient with our spending, doing cost-benefit analysis, being very mindful of when we're executing contracts and other kinds of spending, not just for our own, balance sheet, but also just in the bigger picture in the context of the state and what we're operating with right now. And we want to be supportive in spirit to kind of those efforts that the state's undergoing. Now I'm going to pass it over to Ms. Madsen, who's going to go over the objectives. Thank you. In regards to our strategic objectives, at the end of Q2 for fiscal year 24-25, we are actually making really great progress. Most things are on target. We do have one at risk that we want to talk to you about today and one off target. Neither one of those is something that we're actually overly concerned about, but in the spirit, again, of being quite transparent about the progress we're making on our objectives, we wanted to take this opportunity to dive a little deeper in on these 2 today. So if we can move to the next slide. One of the objectives that we've marked at risk is related to our desire to complete a study identifying the key characteristics of the first-time home buyer market in California. The reason we've marked this yellow is that technically, at this point in time, given the date that we went into contract with the Turner Center to complete this report for us, we expect to receive the report back on July 15th of this year. That is beyond the fiscal year, and that's why we wanted to acknowledge that, in the spirit of being quite precise, it is at risk in terms of being completed by the end of this fiscal year. Ellen Martin and I do have a meeting with the Turner Center to discuss whether there might be any way to receive the report before the end of the fiscal year. We are in no way concerned that we will not receive the report. It just might land beyond this current fiscal year. So that's why we've marked it yellow for you to consider. Moving to the next slide. The strategic objective that we had marked as off target is related to an initiative that was really around a desire to create a mortgage professionals partner e-news list. The intent of this was to focus communications directly to the lender community. And at the outset of working on this initiative, when we engaged the lender community and those stakeholders, we actually received feedback that they weren't welcoming of this idea. They preferred and enjoy the way that they are receiving communications from us now, which occur by signing up for e-news blasts on our listservs. The lender-specific communications that we were considering would have required credentialing, extra credentialing to prove that you are indeed a lender and can then access this. And it created more barriers than they felt were necessary. And they communicated to us that they felt that would actually potentially impede our ability to communicate well with that stakeholder group. So, taking their feedback into account, we've decided to cancel this initiative, which again technically means we are off target and we will not be meeting that initiative. So wanted to pass that update along to you as well. If we can go to the next slide. Some highlights from the end of Q2, one which really almost needs no mentioning, but Stephanie McPadden has joined CalHFA as the Director of Multifamily Programs. So that is a big highlight for us in Q2, but one that you are all quite well aware of today. There are a couple others on the financial front that at this point I will pass it along to Erwin Tam to go over and finish out the financial reporting. Sure.
Thank you, Chair Cervantes, members of the board. The last two highlights, I think if you joined audit committee from this morning, our comptroller again announced that our 7th consecutive GFOA award for excellence in financial reporting for the ACFR. And again, from last board meeting and the last board meeting of last year in calendar 2024, we already mentioned the fact that the agency did successfully issue $107 million of revenue bonds to support its multifamily lending programs. We're obviously planning to go into the market again and working on a new Opportunities Committee initiative for the My Access program to issue bonds for that as well. So much more to come on the finance front. Moving ahead to the agency's operating results, I will say that the next two slides are sort of the graphical representations of the final slide in this presentation. And I never pass up a chance. So can we move to the last slide? Because I love spreadsheets. So to talk about a spreadsheet. Again, this is all the same information that's presented in a graphical form. So, but if it's too small on the screen, it's also located on page 83 of your packets. So let's talk. I know Director Russell referred to the rule of three, so let's talk about three different things. Single-family revenues. Single-family revenues, and also following the rule of three, have three major factors. They're above budget and above projections, and the reason why is, one, the agency is doing more loans in its single-family programs. Two, we're doing the average loan size has been larger than was projected. And three, we're getting actually more revenue per dollar of loan size. So those three factors together have resulted in a significant positive variance for the agency to the budgeted amount. And you can see that there, again, year to date and at the end of year financial projections. Multifamily lending programs is on budget. We expect it to end the full fiscal year, pretty close to where we expect budgeted at the end of the last fiscal year. And in operating expenditures, the agency has received, probably about $2 million, or expects to receive about $2 million in salary savings, and an overall expenditure level about $4 million below operating expenditure budget. So all three of these things, again, single family being above revenue expectations, multifamily being on budget, and operating expenditures being slightly below, have resulted in a significant increase to the net operating position projected at the end of this full fiscal year for CalHFA. I know I went very quickly. I know I'm also the last person before probably the end of this meeting, so feel free to ask any questions. I feel like I missed out on a bunch of different questions, so feel free.
We'll try to turn up the heat onto you then. Are there any comments or questions from members of the board? I guess, well, let me take Director White, thank you for bailing me out.
Sorry. Just what's the timing on the bond issuance for?
We're currently engaged with a senior manager and our legal counsel, external legal counsels, and we expect to be working toward a posting. And per our debt policy, we will be alerting the board to when we actually, sorry, I take that back. We actually have announced the program release. There's a 30-day bulletin that went out, so we will be issuing bonds obviously before that becomes effective, obviously to effectuate the program.
Thank you.
Thank you. I think I had two things. First is and this is the staff report, the strategic goal one And there's a question as to whether we hit the multifamily target or not. And that's, I gather, is like more a market dynamic? I mean, is that, maybe just a little color behind that would be helpful.
Okay, Stephanie's gonna keep me honest. I'm gonna try to earn my paycheck right now. So, there's a lot of things that could happen between now and June for, yeah, there are market dynamics, there's our regional dynamics, obviously in Southern California, et cetera, that could cause a deal to drop. And it also could be, I think, as Stephanie highlighted in the timeline slide of the MIP presentation, some of the directors here are very well aware, the capital stacks and these numbers that they're working with are coming in different and up until the moment we need to press go. And so any one thing, it could be deal specific, could make a deal drop. And so that's kind of what our anticipation is. The reason why we're marking it yellow is the goal was created by saying, this is our entire pipeline. And if everything goes, that we will meet the goal. We didn't create a buffer for ourselves. We're playing like a zero-sum game on these goals sometimes. Lessons learned, and I take this one to heart, and this is, my algorithm, so I will take ownership of it. So that's why we're saying that, it could any number of things, but I think you could probably give a little bit more on the actual market conditions right now that we're seeing. Sorry.
Sure, yeah. First of all, it's totally normal for a lender to have deals that don't close when they say they were going to close. Completely normal. My estimates of goals will be a little different than 100% of pipeline. So, great. And we're in a period in the market where we are hearing from developers that as they're getting their tax credit equity LOIs, the pricing is lower than they had anticipated. So then they have to go fill that gap and find dollars to make the deals come together, which takes time. And we have identified a handful of deals that we just don't have a great feeling about them meeting their initial deadline. So this is something that we are actually seeing this a little bit in our conduit business. So our non-CalHFA perm loan business, which is a good indicator of the market in general, that there are delays just overall in the market. So we're tracking it. We're very actively involved, talking with our borrowers and managing these timelines as best we can within the constraints of the CIDLAC deadlines, et cetera.
I did want to remind the board, the goal is a growth goal. It's a 5% growth. So while we're marking this yellow and may not meet the count, the unit count, on like the revenue and the operational budgeting side, Mr. Tam, we would be alerting you differently if the goal, we felt like the goal wasn't going to be met from an operational, balance sheet profit and loss standpoint, right? Where when we're talking about missing a goal, we're missing a growth goal. I don't like to not miss goals. We all know that. And I'm obviously aggressive in my goal setting, which I need to work with Stephanie on. But I want to make sure that that point's made. The overall financial health of the organization is not in jeopardy here when we're marking this goal yellow.
Great, thank you. And on the marketing communication goal, which to me that makes sense. If we're offering something, a platform, and people say that's really not helpful, to me it seems like the right response, say, okay, fine, we're not going to do it. So I gather that was the gist of it. And through the outreach, we kind of found that this approach really didn't resonate, and we're letting it go.
Yes, that's correct.
Yeah, so I appreciate that. Yes, Director Sotelo?
Thank you very much. My advice on the goal regarding the multifamily lending is that traditionally you want to create goals that you can control the factors on. We can't control the market. We can't control the lenders. We certainly can't control what developers do or don't do. So when we think about setting the goal the next time, let's talk about what we can control and measuring to that. So if the goal is to increase, our portfolio by 5%, then the things that we can control is outreach to the developer market. Once the LOI is set, being able to produce documents, manageable goals that, again, we can control from a staffing perspective, not necessarily from I'm a big fan of being aspirational in terms of how to grow the organization and how to grow our outreach. But the reality is that, we don't control everything. So just measure that goal based on our ability to, create the levers that we need.
We appreciate the feedback, and I'm going to steal Kelly's thunder a little bit, but going into the March 19th workshop, one of the sessions will be dedicated to a higher level. It's kind of the entry into, we're in the last year of our business plan, so our strategic plan will end in June of 26, meaning we need to spend the next fiscal year developing a new strategic plan, and that will actually be something that we want to do with the board. So at that strategic level, what are meaningful measures of success that you would like to set forth for us? And we'll be starting that conversation entering into our 50th year. We really want to talk in a visionary sense of what does the next 50 years look like for this agency, and how would you prioritize we get there, right? So looking at that in the workshop sense. So I think the comments, Director Sotelo, are very timely, that we will be actually, while we have one more year of these goals and measures, that we will be looking for that kind of counsel and guidance from the board in the next year.
Okay. Director Russell?
So this is a little bit out of left field, but since the whole team is here and we're talking about risk and we're talking about performance, I will say that the developers I'm talking to are all talking about some pretty significant risks that we're seeing in discussions around the federal budget. Have we evaluated our own portfolio, and especially sensitivity to Section 8 project-based vouchers? Is that something we can maybe spend some time on at the workshop next month?
Yeah, we certainly can do that. I am also very curious about what our voucher exposure is. I had always thought that was something that was always going to be safe, but I agree we should look at that going forward.
And how does that filter through? Because it could be dire. We don't know. In the next 2 weeks, we're going to find out, I guess.
Yes, indeed.
Yeah. Yeah, really. Maybe one last one for Mr. Tim. I'm trying to get across the board here. So $32 million to the good.
Yep.
So I gather it was fueled at the first quarter, Dream for All and so on.
Yeah. It actually was, Dream for All was already sort of calculated in there. It's actually the agency's My Home program that has withstood. Again, what we've talked about in the past is that CalHFA is the largest provider of down payment assistance in the country, and therefore, even though rates remain high, our flagship My Home program still remains very attractive to first-time home buyers.
Mm-hmm. So you think we end the year kind of close to something like this, or is there, for managing expectations to your board, probably skinning it down?
We've already banked a significant amount of the positive variance, and to the extent we feel otherwise, obviously we'd make a third quarter adjustment downwards. But there is, still the expectation that everything seems to be chugging along pretty well, in terms of our My Home program. And again, to the extent we will see, obviously, when we deliver the My Access program, which has a slightly different funding source than the TBA revenues and the securitization process there, we may need to make an adjustment for, either late this year or next year. Probably not late this year, because again, we've already accrued a significant portion of revenue before this program will launch. But, there may be, ongoing operational expense. Our revenue will be received differently. And again, a bond execution is more over time, and a TBA execution is upfront, one-time monies.
Okay, great. Thank you very much. Any last questions from the board? Are there any public comments or questions?
Do we have any members of the public interested in making a comment at this time? We do not.
Great, thank you. Thank you all so much. Really appreciate the update. And with that, we'll move to agenda item number 9, informational written reports. There were 4 reports in the board package that you've had a chance to peruse. Any questions from board members on those? While we have staff present? Okay, all right. I think you can make a safe escape. Then we'll move to number 10, other board members. We've talked a lot about things to talk through at the next meeting, the workshop. Are there any other items? It's not agendized, we can't really discuss it, but like you'd want to bring up for maybe a future discussion at the board. So I put that out there for board members.
I'm very intrigued. I've heard twice today about non-LIHTC, non-tax credit, affordable housing, and I'm interested in those models.
Yeah.
Whether that's March or whether that's down the road, understanding better
Yeah.
that question.
Agreed. Okay. And then with agenda item 11, public comment, just to speak, public comment for any matters under our authority that may not be the agenda. Let's see if we have any comments.
Any members of the audience interested in making a comment at this time? We have none.
Great, thank you.
Mr. Chair, I did have one, I'm sorry, we raced out of 10 so quickly. I just wanted to call attention to the work of Chris Sauer and the notes that I read from him on a week, the press updates. I forget to send a thank you when I receive those and read them, but they are an invaluable source of information, and so I just wanted to acknowledge that in the public.
Well done, thank you.
I know Mr. Tam thinks the bond issuance is the secret sauce, but actually it's Chris Sauer.
That's great. Well said. I think with that, we've run through everything except adjournment. Again, I'd like to thank you all, and this meeting ran longer than the past one or two, but we banked the time from before, so I'm kind of pulling it back in. Well, I'm looking at this side
Chair
over here.
Cervantes.
So with that, meeting adjourned.